I was looking at the dual agency section.
Hmm.
Is dual agency I know it's when one buyer and seller are working with the same firm. Does
Hmm.
that mean like the same like everyone in that firm or just one specific agent in that firm?
Good question. So let's see, it could be either or. Um, but it is definitely that the firm is a dual agent. That is absolutely true. Now, the question then becomes who within the firm is handling this transaction? And at this point, since the firm is a dual agent, then um, the agent that those folks are working with is also the dual agent to them. But if it becomes designated dual agency, then it's still dual agency, but it's more specifically designated, meaning one of the two, buyer or seller, gets assigned a designated dual agent just for them. And then another person in the same firm gets assigned the opposite party just for them. As long as neither one of those agents know anything confidential about the other client, they're allowed to be a designated dual agent. And so those two designated dual agents, that's what they are, while everyone else in the firm is a dual agent. Don't forget that designated dual is not exactly the same as true dual agency, right? What makes designated different? It's better. It's better in that we've restored loyalty. So we're giving one side their own agent that can share with them any sort of confidential info they might stumble across about the other client. And they are there to take as good a care as they possibly can of their side, their buyer, and then the seller's designated dual agents taking care of their seller. If they were to find out something confidential or negotiating about the opposite party, they would be required to share it with their own side as a designated dual agent. But if they don't ever become a designated, but instead remain a true dual agent, then they can't give either side an advantage over the other, right? So the designated dual, everybody in the firm is also a dual agent, but only those who are designated specifically to those clients are designated dual. I don't know if that helps, but yeah. Good. Please ask away. Ask those questions. Let me see here. Okay. Now, putting in the chat something I just put in Notion earlier within the last hour, and it is a finance math worksheet. It looks like this. It's 5 problems um, of that math stuff that we've done the last couple of times. So I didn't give answers. You're just going to have to do it, and then we'll go over the answers later. So look for that in Notion or print it out, save it, print it, whatever you want to do. It's there in the chat for you now. Go ahead and do that for next week, and we'll go over it next week as part of your homework. In addition to preparing for next week, go ahead and do the midterm from Class Marker. Now's the time to go ahead and do that midterm exam between now and next Wednesday. And again, as you're taking it, if you run into a question that's just ridiculously confusing, or you just need a refresher on something, take a little note. Make a little note of any of those questions on that midterm that you want me to go over together with you. We won't have time to go over every single question, but I will go over anything that you're specifically confused about. Some of them you'll be fine, and some of them you might have questions. So let's do that, because we need to just keep on marching through our content here. Here we go. Secondary mortgage market. I think we were just getting into that last night. And again, that's when all those primary mortgages, all those individual mortgages that were created are packaged up, hundreds and hundreds of them, maybe thousands, and of similar risk. How do they know how to package them up? Well, they're not going to, credit scores and credit history is in, if you hear it referred to as A paper, that's the best credit, right? A paper, A, B, C, D, like that. Great credit scores are in the 800s, maybe down to 750. That's an excellent credit score range that won't have any trouble borrowing money. When you get from there down into the 6s, that's good. When you get down into the 5s, now we're getting into the fair to poor territory. You're going to have challenges and limitations on even being able to borrow. Your choices will be fewer. So the lender would not package up A paper credit with B or C paper credit borrowers or loans to people with those credit scores. They're going to stick with all A score people, all 750 or above, or all 650 to 750, for instance. Maybe not exactly, but that's the idea. And it's because it makes it more of a dependable product that they're selling and they're trying to sell to other lenders. That lender buying it wants to know that they're pretty darn sure these different thousands of borrowers in this package of loans are going to pay as promised. And that's what makes it valuable of a certain range of price. And that's why they pay a premium to that bank who's selling them. And so now the bank that has now sold these packaged loans off, they're getting a big chunk of cash, which they're going to use to then make more single loans one by one by one, all so that they can package those up in the future and do the same thing all over again. And the banks that buy these packaged loans are doing so because they want the long-term earnings. There's benefit to them to have interest earned over the coming years. So that's the process we're talking about here. And so the marketplace, I imagine it in my head like a flea market. Anybody ever been to like a flea market? Little mom and pop walk through the tables set up, and some people are selling, maybe jam in jars, and some people maybe homemade T-shirts, and some people maybe some sort of little craft out of wood. It's not that, but it's a marketplace, right? And so Fannie Mae is the largest and oldest one of those marketplaces. And what do they sell? What types of loans do they handle? All of them. Conventional FHA and VA loans are bought and sold on the Fannie Mae marketplace. Fannie Mae does some other things, as we closed out last night talking about. Yeah, I'll do that. I'll see your message there about the sheet. I'll email it to everyone, by the way. Maybe try to remind me at the end of class. And I'll email it to you just in case you're having trouble downloading it. It's also in Notion, if that makes a difference. But I think some of you might have had trouble with Notion too. Question in the chat: key term difference between willful misrepresentation and willful omission, because I keep mixing them up. Good question, because that is a common mistake. So let me take a little side street here about that while I'm thinking about it. Willful misrepresentation versus omission. You need to look at the last word first. That's the best way to handle it on the test. And so don't worry about willful versus negligent yet. Just think, did the person who's being possibly guilty of this thing, did they say a thing, either in writing or voice? Or did they not say something at all, kept their mouth shut because they didn't want to let anybody know of an important fact, material fact? That's the difference. So if you give me more of a specific thing, like if you give me whatever practice questions you're running across, current slide is about Fannie Mae. If you give me that exact thing, we can analyze it a little better. And don't forget, in the comment section, I think around page 4, 5, 6, somewhere in there, this material starts, so you can see 5 or 6 examples of each of the 4. But an example would be, if I'm an agent on a listing appointment and I look in the closet and I look at the ceiling of the closet, that's kind of hard to see. Not everybody would think to look at the ceiling inside the closet. It's a little tiny closet, not like a walk-in. In the ceiling, I see a water stain on the ceiling. And I think to myself, oh, either an active leak or a former leak. I wonder what's up with that. If Well, first of all, if I find out that that's a leak that has not been repaired, the roof is still the old roof. The seller says, "Oh, funny, I never saw that stain before," and it's still there when we put it on the market and a buyer comes through. Am I obligated to tell that buyer agent about that stain as a broker? Do I have to disclose it? So, question one, do I have to? Far as I know, it's not been fixed. It's still a problem. I know it's there. I saw it. I found it. So first of all, am I obligated to disclose this potential material fact? Yes or no? Yes, I am. Yeah. So now let's advance to what I do about it. If I go ahead and tell the buyer, yeah, there's a stain in the closet in there, seller said they didn't know about it before, and I don't know of any repairs that have been done. What did I just do? Did I represent something? Did I tell something? Yeah, I shared it. I disclosed it. What if instead of that I said, hey, there's a stain in the closet, but it has been fixed. No big deal. Seller already fixed it, and that's not true. The seller, in fact, told me, I don't know where that came from. I'm sure it's fine. And I just ran with it and told the buyer agent, I said, yeah, the stain is there. Don't worry about it. You can just paint over it. It was already fixed, and it's a blatant lie. Then I have misrepresented, right? I don't know that it's fixed. In fact, it probably isn't. And I told something that I didn't know, but I said it. I told it. Instead of telling it, though, let's look at another option. What if instead of that, remember, it's in a closet. They probably aren't even going to see it. What if I just kept my mouth shut? It was shown 14 times the first weekend, and at no point did anybody ask me about it, and at no point did I mention it to anyone. I have omitted the information. That's a willful omission. I chose to keep my mouth closed about it. Do you see the difference? That is misrepresentation versus omission. Whether you keep your mouth shut even though you should have spoken up. And then misrepresentation, when you say something but it's the wrong thing. And then the next test is, did you do it on purpose or did you do it because you were negligent? On purpose means I said the wrong thing on purpose. That's willful misrepresentation. I kept my mouth shut on purpose so as to defraud them. That's willful omission. Or negligent misrepresentation would be, I didn't bother to even look around the house, and so I didn't even see the stain, and I just assumed everything was great, and I said, this house is perfect. But I never even opened up all the closet doors and looked around. That would be willful omission. Because on purpose, I didn't bother to do my job. Actually, that's negligent omission. Nope, sorry. Oh my gosh, I'm sorry, guys. See, it gets me too. That's negligent misrepresentation because I said everything was great because I was negligent and didn't bother to check it out. Negligent misrepresentation. I said the wrong thing because I didn't verify. Negligent omission would be if I didn't bother to look around and I just kept my mouth shut and didn't say anything about the house and they just assumed everything was great. So it is, you just have to kind of clear out your mind and think, okay, wait a minute. What's the second word? What's going on with the second word? Is it misrepresentation, meaning I voiced thing? I either said or wrote information that was wrong, I misrepresented, or I kept my mouth shut. Then the next test is, did I do it on purpose willfully, or did I do it because I was lazy and slack and negligent? So this is Fannie Mae, the marketplace here. Again, they purchase conventional loans. They also purchase FHA and VA loans. Here's the thing about FHA and VA loans, though. Remember, they are for making sure that people who can't get a conventional loan can still own houses. They are noble, right? We're glad they exist. For the VA loans, we're helping veterans and military people, kind of giving them a step up because of the commitment and sacrifice they make serving. For FHA, it's to help people with maybe more challenged credit scores, maybe not as much available down payment money. Either way, it's good to have more homeowners, is the idea here. Well, we also talked about how if you get a conventional loan, Typically, unless it's a special program, you're going to be expected to put as a down payment at least 5%, maybe 5, 10, 15. If you do use an FHA loan, you're probably doing so partially because you don't have 5% or more available as a down payment. You have less down payment, and so FHA allows 3.5% down. If you're putting less down payment, the logic follows that. If times get hard for you, compared to somebody who put a 10% down payment of their own money, you and your 3%, 3.5% down might be more likely to let the loan go into default and not pay if life really gets bad for you. And so the idea is an FHA or a VA borrower with less down payment, meaning less equity in the house, is more likely to let it go into foreclosure than somebody with more of their money for down payment, more equity as they walk into the house from the beginning would, right? More likely to default to some level. So Fannie Mae would rather, the marketplace itself would rather only buy and sell conventional loans. They don't really want to buy and sell FHA or VA loans. It takes a very special extra level of security for them to allow the FHA and VA loans to be packaged up and sold in their marketplace of Fannie Mae. What is that security? The government. The government, through the Ginnie Mae marketplace, says, hey, Fannie Mae guys, feel free to buy and sell FHA, VA loans, because if they go weird, we will back them up. We will protect you to some level. So it's only because Ginnie Mae stands up and kind of makes up for the risk differential of those FHA, VA loans that Fannie Mae even allows and will allow them to be bought and sold on their marketplace. Does that make sense? Do you see the difference there? So Ginnie Mae deals with FHA, VA loans. They work with Fannie Mae to say, look, we'll back these loans. You go ahead and buy and sell them on your marketplace because we got your back. In case those borrowers default, we'll pay the risk differential. And Ginnie Mae also allows investors to buy shares in pools of loans, like big collections of loans. They'll let investors buy shares in those, and they'll pay directly to an investor. So it's a government agency under the Housing and Urban Development Department of HUD. And then that leaves Freddie Mac, the Freddie Mac marketplace. That's the Federal Home Loan Bank System. I don't know how they got Freddie Mac out of this. I think they were just trying to come up with a cute name. And Freddie Mac is a marketplace that's smaller than Fannie Mae, but it deals in conventional loans. It also deals with financial institutions called savings and loans, mortgage banks, and they also pool the loans together and sell bonds against those loans. So let's look at smaller Fannie Mae and for more, I guess, smaller type banks, savings and loan type banks, and they prefer conventional loans. So that's the main marketplaces of the secondary mortgage market: Fannie Mae, Ginnie Mae, Freddie Mac. You don't have to know that much and deep dive too much into this. Just know the basic skeletal structure there. Obviously, we got to talk a little bit about what led up to 2008 mortgage crisis. If you read or watch The Big Short, the movie or the book The Big Short, it gives you an interesting little perspective, almost an inside view. I don't know how accurate it's. They admit to their inaccuracies, so they'll give you little disclaimers in that movie and say, well, this isn't exactly what happened, but it's kind of the gist of it. But what did happen? Life was great my first 12 years in this business. I didn't even understand any perspective as to how good it was. I was just brand new and young and dumb and trying to figure it all out and didn't appreciate how good it was. Because 1996, I got in the business. Fast forward to 2008, I had 4 closings set up for October of 2008, and all 4 of them fell apart. And I think at the time I was at Remax, and I had to pay $1,100 a month just to walk through the doors as a desk fee in exchange for a 95% commission split. So I got to keep almost the entire commission. But if I didn't sell something, I still had to write an $1,100 check. And I was expecting 4 closing checks that month, and none of them came through. And I sat up and looked around and thought, what is happening? Is this just me? And realized, oh man, no, it's not just me. But I felt stupid because I felt like I should have seen it coming. Me and a million other people, right? The ones who did see it coming are the ones who benefited the most. What happened? Back in those days, in the years leading up to 2007 and 8, lenders were feeling very confident in the mortgage market, in real estate. All those investors, if you had money to invest, like insurance companies, like individual investors dealing with those $1 million funds, if you had that money, where would you want to invest it? In the most stable, secure instrument you could, while still having some modest risk avoidance, right? You're trying to get a decent return without too much risk. So the best risk, lowest risk, would have been for them to put it in a bank savings account. But that's ridiculous because it wouldn't even be enough of an interest rate return on their money to overwhelm inflation, to overcome the amount of inflation, right? It's a pitifully low amount, but it's a lot of really low risk. So it needs to be better than that, but not so risky as something like maybe Bitcoin or gambling on slot machines or something like that, right? Somewhere in the middle. And so investors really liked residential real estate in general. Yeah. They got too comfortable with it. The logic was people will absolutely, even if times get bad, they'll not want to give up the place they live. Surely they won't stop making their mortgage payment. They'll let their house go. I mean, their car get repossessed before they'll stop making their mortgage payment. But have you ever ridden past certain entry-level, low-income housing, mobile home parks? I don't know, the lowest entry-level price point in your area. I see some pretty fancy cars in front of those mobile homes sometimes. People like their cars. It makes you feel good. You can't quite blow out the $300,000, $400,000, $500,000 house, but you could swing a $40,000, $50,000 vehicle payment, right, on something like that. Not that you should, but it's a thing. And so they got it wrong. These investors taking such great assurance and comfort in their logic that people wouldn't let their houses go into foreclosure were wrong. Add to that, because of this false security, they started getting even, think about it. If you're in the business of loaning people money, the more people you can loan money to, the more interest you're going to earn. So why not open it up to even that bunch of people that can't typically up to now afford homes, people with the lower credit scores. So that's where we got into subprime mortgages. Subprime meaning less than perfect credit. And so then they would say, hey, wow, let's just loan money to people with B and C level credit, because surely they'll also pay their house payments back too. And the problem was people with that credit score probably had maybe less money available and life going sideways for them, taking a detour because of some catastrophe probably was going to hit them hardest, fastest. And it did. It quite commonly did. So a lot of subprime mortgages were made because they felt like it's still safe for them too, because even lower credit borrowers are going to make their house payment. They even got so cocky as to remember we did LTVs last night? We did some examples of 90% LTV, meaning a 10% down payment, borrowing 90% of the appraised value or purchase price. There were 125% LTV loans done back then. What does that mean? It means the lender loaned them more money than the house was worth. It means on closing day, they got the keys to their new house and 25% of the house value in their pocket. Oh, good. Now I can go to Rooms To Go and put furnishings in this nice new house. Now, what should they have done with that extra percentage? Probably something to increase the value of the home, or something financially smart, or socked it away in some other kind of investment. But no, they had fun with it, right? They just kind of kicked back, enjoyed it, bought maybe disposable things. Even if they bought blinds for the house, that's not really a huge return on your investment kind of investment. So a lot of that happened, and that wasn't good either. Another thing that happened again, because the lenders realized, let's make these loans available to people with even lower credit. So therefore, how can we appeal to more of them? Well, let's oh shoot, I just blanked. Sorry. It's going to come back to me. I know it. Wow. It just poof. But I will think of it. So let's see. The 125% mortgages, LTVs, the they were giving money away. You got it. That's exactly what they were doing. They were throwing it at people. People couldn't run away from it. It was super easy to get loans. In fact, I remember at the time I got word that down in Florida, because Florida is sort of if we see what's happening down there, then what's happening up here is a smaller version of that. If they're seeing really steep appreciation, we're seeing appreciation, but just not as steep, or the opposite. And so in Florida, people could start building a new construction home. And if it took like 5 or 6 months to complete it, by the time they got the keys and it was finished, it had already appreciated significantly. And they could immediately turn around and flip it and make a profit. That's how fast and ridiculously the appreciation was happening. So yeah, a lot of misbehavior there. Oh, good. Yeah. Worked for a company that created loan apps when the housing market crashed. Behind the scenes, you bet. The approvals and people didn't qualify. Oh, that too. Yeah, lenders trying to get people's approvals to push through would maybe endorse. Some people might actually create fictitious tax returns, documentation just to get the loan underwriter to approve it. And it was fraudulent, right? It was loan fraud. And so the person actually couldn't afford the house because they were lying about their ability. And so then when the market turned, when things got challenging in their life, they couldn't handle it. They couldn't cover it. Oh yeah, here it is. What I remembered, forgot. Another thing people would do in the subprime category, they would maybe not be able to afford the traditional loan at maybe 6.5% mortgage interest rate. So the lender would say, don't worry about it. Instead of a fixed rate mortgage at 6.5%, let's do an adjustable rate mortgage at 4.5%. So your payment will be based on a lower interest rate, but not for the entire 30 years. It's adjustable. It's going to adjust over time. And they jumped on it. They ate it up. Oh, great. Everybody else is paying 6.5. I can pay 4.5. Yes, for a year. And at the end of that first year, it's going to adjust. Hey, but it might adjust down. Yeah, and you might win the lottery. And it just depends on, right, what the financial markets are doing as to which direction it's going to adjust. And quite often it adjusted up. And so instead of $1,200 payment that they enjoyed the first year, when everybody else might have been paying $1,500, it adjusted to $1,350 the second year, and then $1,400 the year after that. And it could have adjusted every year. And that was the risk they ran, because they thought, oh, surely by the time it adjusts, even if it adjusts up, I'm sure I'll have a better job. I'm sure I'll get that raise. I'm sure my life will be better. Because as humans, our nature is to overestimate how much better it's going to be in a year and underestimate how much we can improve things if we do a little bit at a time. And I'm the worst about that. I like to do things in big chunks. I never bring the groceries in 2 bags at a time. I have to stack all the bags on both arms with one trip, if at all possible. Why? It's just another 2 minutes, if that, right? But we like to do things in big chunks and get it done. We're impatient. Well, sure enough, all this stuff caused prices to go up too, and people to be more excited about stuff, but not like we have it now. Not to the point where appreciation was just support. Once the market dominoes started falling, the prices started falling, the values started falling. So when people will start going into foreclosure, the values were lower than the amount they had mortgaged, especially those 125% loan to value ratio folks, right? Because the house, they owed money on to the lender much more than what they could possibly sell the house for. And that's when short sales got super prominent. There were a couple of agents in my market that, I don't know if they had a crystal ball or just luck, right place, right time, but they went ahead when the market was still good, early 2000s, and got cozied up to several banks and got to be the major agent for certain banks, to be the go-to listing agent for those banks, and partnered up with them so that when all this happened and now the short sales were just going crazy, those banks and partnered with those agents, and those agents made a killing because they were the go-to agents for these major banks. And that you couldn't really just break into that, but they would go with the same partnered up agents they'd been dealing with. So agents who did that came out really well. But dealing with short sales, you might have gotten the idea when I was explaining it earlier. It's its own weird animal, right? It's not the same thing as just a one-off buyer, one-off seller. You've got to wait for some lender's permission, and that takes turtle pace. Oh, we need this tax return. I know I sent it last week. Well, we lost it. We need it again. And it's just mind-numbingly slow. And you're dealing with different people answering the phone at the call centers until finally you maybe get assigned to a negotiator who might be the same person now, but that could take months before it gets to that level. And it's its own specialty. You've got to, I think you really have to have the mind of a CPA detail person just dealing with systems and calling procedures to be good and gifted at that particular part of the market. So it's great if that's your thing. It wasn't my thing. I hated working short sales. So that's what we dealt with, and that's what led to all of that. The difference between then and now we're dealing with a market shift, but the values are up significantly still because the inventory is down still with no real end in sight in the next couple of years. Where's the inventory going to come from? For one thing, sellers are realizing, well, yeah, I could probably sell for a lot because the values are up, but what would I do then? What am I going to do? And so unless it's a seller selling in order to buy something smaller, they're going to have to use every bit of what they make on their sale, but end up in a smaller house because the values are higher than they were back when they bought it. And then those buyers over the last couple of years paid so much to compete with other buyers and over asking price. They're not selling anytime soon, probably, unless they just have to, unless maybe their job is moving them and will help them pay for some moving expenses. So it's an interesting sort of transitional moment, but it's not the same as that. Thank goodness. We'll see some foreclosures. We'll see some short sales. I was curious after that COVID year of loan forbearances, what we might see as consequences from that, but I haven't really seen or heard of a lot of foreclosures or short sales as I expected. It's always going to be some amount of them, but that was what happened out there. A lot of defaults, a lot of foreclosures back then, mostly because of the subprime loans. And I think I've already mentioned to you early in this chapter, the other thing that we saw a lot back then was, first of all, stated income loans. Stated income. What do you think that means? I'll give you a loan. Tell me how much you make. By the way, you need to make $400,000 a year in order to buy this house. Do you? Yep. Okay, sign right here. Not much more than that, guys. You stated your income. It could be a lie. You stated it, you signed it, they felt pretty confident that you would pay your mortgage, and they made the loan. And guess what? You got a little carried away. You lied a little too much to get to that next because, buying houses is fun until you actually have to pay for them. Shopping for them on HGTV is really fun when you can have a $3 million budget because you're really not going to be buying it. You're just looking. But when you have to actually find the thing with all the perfect things you need or want for a certain budget, it kind of makes it a job instead of quite so much fun. So people would try to stretch a little more. And the builders were smart. They said, well, for $300,000, you can have this house. Oops, but it doesn't have a fireplace. We need another $4,000 for a fireplace. Oh, and this is with Formica vinyl, basically hard vinyl counters instead of granite. Oh, you want granite? That'll be another $9,000. Oh, and this is with the floor plan that doesn't have like the openness to it. This is the entry level floor plan. And oh, you want to bump up to the next floor plan with like that open concept? Another $14,000. And so you walk into the model thinking the price on the banner out at the street said homes starting at $250,000. But what that really meant was we're in phase 3 now. So homes actually start at $290,000. and then add on those things. And it just was like, oh, more and more. And I can squeeze this out. Maybe if we don't buy a car as soon as we thought we would, we'll go ahead and get the next bigger house. But then you squeeze into the house, you're in it for a couple of months, and you're like, boy, that car would sure look better in this nice new house driveway than this old car that I've got. And boy, our old furniture sure needs to go away. We need to get nice new furniture to dignify this nice new house, because the neighbor we just met has that cool leather couch and ours is that old one from 20 years ago. And when you live in a place, you just get more inclined to buy the nicer things to kind of fit in that whole keeping up with the Joneses idea. So all of that led to this stuff, stated income loans. And then the pick a payment finally was another thing. The lenders said, don't worry. If life is a little bit of a struggle for you right now, you don't have to make the full mortgage payment of $1,500. Pick which one you want to make. You want to make the $1,500, which pays down your principal a little bit, or do you want to make the $1,300 one, which doesn't pay any principal down, it just pays us our interest, but that'll get you by just 1 month. And then you're like, boy, it sure was nice not having to pay that extra $400 or however much that math is. That extra $200, $300, $400 could go toward that new car, that new couch I financed, whatever. And some people got addicted to that lower payment, and in the process, they weren't making any progress on paying their loan down. And so then when the values kept coming down and the loan kept staying the same, and then they got in trouble because they had a job loss or a medical problem, and they had to sell the house, but selling it wouldn't be enough to pay off their loan. Welcome to the short sale world, or worse. If the lender, by the way, just because you asked for the short sale from the lender didn't mean that they'd give it to you. They might say, no, this doesn't make any sense for us financially. We're just going to go ahead and foreclose on you. And that buyer you got willing to wait for the short sale approval goes away, and the short sale didn't get approved, and now you're still can't make up your mortgage payments that you were late on, and you can't afford to make them up. Plus you can't afford the extra penalty on top. And once you're in a hole, it gets deeper. So the funny thing is, someone said, do banks still do interest-only loans and payments? Yeah, they do. And it just depends on your strategy. None of it is bad. It just depends on full disclosure and making sure it fits. Just if you need one month, and if you were going to make an interest-only payment, I think December would probably be a pretty smart month to do it. But don't keep doing it, right? December gives you an extra few bit of bucks to spend on all these other things we're buying right now. But that's the problem. And then even an adjustable rate mortgage is not a bad thing. Your grandpa probably thinks so, but if it's strategic, if it's for a purpose, if you know for sure, and you're going to actually be disciplined enough to improve your financial situation for next year before the rate does potentially go up, your payment does adjust upward possibly. Or if you know that you're going to refinance in the next couple of years, that would get refinanced out of the adjustable rate into a fixed rate, and be intentional and very smart about it. None of them are bad. It's just that when you use it to squeeze somebody into something and they're not financially responsible. Good stuff. All right. So what else? So now let's talk about those individual loans. Here's some more testable material. Somebody could go in and get a conventional loan. And I think I've already mentioned this, and I say this to buyers. Hey, buyer, I have one right now that's a military guy. And so he's thinking VA loan. He's got a VA loan on his house in California. He's going to sell that house and move here sometime over the next several months. And so I said to him, well, he said, we're going to use every bit of what we sell our house for here in California as a down payment on the one we buy in North Carolina. Here's the good news. They've been there a couple of years. They'll probably end up with a couple $100,000 from the sale of that house. Should he then come here and do a 0 down payment mortgage just because he can through the VA? It's up to him. But just because you could doesn't mean you should. I would suggest to him, and I did suggest to him, consider the VA loan because they might give you a lower interest rate, but don't just do the zero down. Use a good chunk of that money to get your loan amount down so that you can have a lower payment, and then that lower interest rate through VA plus the adding more, not having to borrow as much as it's actually being sold for, will benefit him. What might even be more of a benefit to him is to at least consider and see the numbers, let the lender run the numbers on a conventional loan first. Because VA has its advantages, low down payment, no down payment, and lower interest rate probably, but it is more expensive, meaning there are additional fees tacked onto it. So he might want to see if he qualifies for conventional first. But why conventional? Why is conventional lower fees, lower? Because it's geared toward better credit score borrowers and borrowers who are also going to put more money down, which means lower risk. The lender's not as worried that those borrowers for conventional are going to walk away without paying their mortgage. So even a VA military person should think conventional first. See it. Just see what it means. Have a lender run the numbers on conventional and VA, maybe even FHA, and then pick and choose. What is so good about conventional? It's a lower loan to value ratio, meaning you're borrowing less. You have to put more down payment, right? More of your money means less that you're borrowing. So there's less risk to the lender. If it's a conforming loan, that means it meets certain guidelines and it conforms to what Fannie Mae wants it to. They wanted to see your bank statements, your tax returns, your check stubs, your pay stubs, a lot of things to see, and your credit score, credit history, so they can see, oh, this is a safe borrower. This is a borrower who has always paid her bills, and we love loaning money to people that pay their bills. So that's what a conforming loan means. Conforming to the requirements of the lender. The requirements are what? Let me see these financial clues that you're going to be safe, low risk. You might want to buy a big fat house, like a big fancy, big priced house, $1 million plus. And that would be what's called a jumbo loan, possibly. You might need to borrow a lot more money to buy that house. You might not. You might still borrow only a couple hundred, but that means you're going to have to make up the rest in your down payment. But if you're borrowing 90% of $1 million house, that's going to be a jumbo loan. And it's non-conforming, right? It's not your typical bread and butter. Not just everybody owns them. So that's what it means by a non-conforming loan. Here's the other thing to know for the test on these conventional loans. The government is not backing them. They are private loans. The government is not insuring them, nor is it guaranteeing them. So you might be thinking ahead and realize, oh, he just said two words, insure and guarantee. And we're still going to be talking about two more loan types, FHA and VA. So be watching for the word insured when we see FHA loans, and be watching for government guarantees, VA loans. Spoiler alert, those are testable things. But conventional, not insured or guaranteed by the government. They're private, and they typically get sold on that secondary market in Fannie Mae because they're so darn sellable. They're so darn cute, right? Because they're so low risk. And just they have that value on that secondary market because the banks love them. So that's what you need to know about conventional loans. Here's another thing. How much did I say you could put as a down payment on a conventional loan? What's a down payment amount that you might run into on a conventional loan? Danielle says 20. What else? Is that the only one? How much lower than that could you get away with? Okay, good. Yeah, 5%, 10%, 15, 20, anything in between. It could be odd. It could be 7%. But even as low as 5. By the way, in real life, you could go lower, but you'd have to have really good credit to get super low. And those would be like specialty programs. But we typically think conventional starts at 5% down. You could do the more the better, right? But at least 5. And so let's think about what that means to the lender. If we look at it like this, And this little scale here is 100% of the price, sale price. You're putting 5% down on this conventional loan, and let's say that's what this little bit is. Right in here, that's 5%. That means the rest of this is the 95% that you're borrowing, right? Also known as 95% LTV. By the way, this little chunk of 5% is the down payment, as you probably already remember. So there's the dynamics. What the lender would prefer, if they could just wave a magic wand and require this of everybody without having to not get more loans, like they have to consider lower down payments because it gives them more potential customers. But if they could say, hey, we only want 20% down payment people. 20%. The lender feels the best and the most confident in the lowest risk that you're going to repay if you have at least 20% down. They would rather you do 20%, but they allow less. But here's the thing. If you put less than 20% down, here's 20, here's 5 up here. They want something in place to account for that extra 15% difference. The difference between what they would prefer you put down and what you're actually putting down, in this case, is 15. If you had actually put 10, then this difference would be 10, right? But the difference is this chunk. And so what could that lender say that gives them a little extra protection for this part that you're not putting down that they wish you would? That is an insurance policy that they require the borrower to take out and pay for, called private mortgage insurance. PMI exists to cover that lender and protect them for that amount different from the 20% that they would really rather you put down. Since you're only putting 5 or 10 or 15 or whatever, the difference between the amount you are putting down and the amount they wish you were putting down of 20% needs to be covered by a private mortgage insurance policy, PMI. Who's heard of that initial PMI before? So it looks like this. Private mortgage insurance benefits who? Not the borrower. Benefits the lender. It covers their butt. Because they're saying, hey, borrower, we'd really rather you put 20% down, but since you're not, then you've got to pay for this PMI. What does that mean? Is it extra monthly? Yes. It's on top of your PITI. So it's your typical mortgage payment plus an extra, I don't know, maybe $80, $100, $150. Depends on the loan itself, but an extra chunk of money to cover them. Now, what is it covering? Eventually, this 5% that this borrower started with, this bit, is going to grow. In other words, initially, that 5% down payment is their equity. That's their initial equity in the house. It's their money. What's equity? It's what you're going to walk away with. When you pay off the loan, it's what's left. It's your money. So they start out with 5% equity because it's a 5% down payment. What's going to happen over time if they're making a fully amortized loan payment, as they should? They're going to increase their equity. It's going to go up to 6%, 7, 8, 9, and just keep going up. How is that going to happen? It's going to happen because of different things, because the house appreciates. So as the house gets more valuable, their equity goes up because of the natural phenomenon of appreciation of real estate. It also could go up if you pay extra on your payment over time. You're paying your loan amount down more and faster. So you're paying this loan amount itself down quicker. Plus you've got appreciation happening naturally. And then third, you might also put more money into the house to make it worth more. Capital improvements. Like maybe instead of a carport that you had when you bought it, You put a garage door on the end of it and close up the other spaces, and now you have a home with a garage instead of a home with a carport. You just spent $1,000 and added probably more than that of value on the house. And so between these three things, you're increasing your equity over time. Now, instead of the initial 5% equity, you now might maybe get all the way up to 20 after 8 or 10 years. Because you paid extra on your payment over time, you added a few nice things and made it worth more, and it appreciated. So eventually, if you get your equity up to 20%, well, that's where the lender wanted you to be to begin with. So is it still fair once you've attained this 20% equity? Would it still be fair that that lender still charges you private mortgage insurance and you have to keep that policy? No. And so it can go away at that point. So as a homeowner, watch out, look for it, and think about it, and plan and budget, and think, when am I going to hit this point where it's 20% equity because of these various things? So maybe in 5-6 years, you get an agent, or you are an agent, you guys at this point, where your client reaches back out to you and says, run me some comps and see where I sit. What is it worth now? I bought it for $400 back when you sold it to me, and you find out, oh, now it's worth $550. It's gone up $150,000. And what's your loan amount now? Well, it started out at $95. Now your loan amount is all the way down to $80. So this gap got bigger, more equity. And so you've probably gotten up to 20% equity in the house. And therefore we can reach out to that lender and say, hey, lender, stop making me pay this PMI chunk, this $80, $100 a month. I don't want to pay it anymore because now you're covered. Now I do have 20% equity. And the lender will say, fill out a form, apply for it. And oh, by the way, prove it. They're not going to believe you or a broker. They're probably going to make the borrower who's trying to get this PMI removed, probably going to make them get an appraisal. You got to pay a $500-$600 for an appraisal. We'll run it through our approval system. And if all that checks out and it looks like you are at 20% equity, then yes, we'll cancel the PMI policy and not make you pay for that anymore. So with a conventional loan, this is possible. It's possible to get rid of that private mortgage insurance. Spoiler alert, for FHA, it also requires mortgage insurance. It's called a mortgage insurance premium, but it's the same thing, but that never goes away. The conventional loan PMI could go away once you hit 20% equity. But even if you hit 20% equity while having a FHA loan, you're still going to have to pay that MIP. That's the trade-off. And that's one example that I was mentioning earlier of why FHA VA loans are more expensive. Because over the long run, you got this to deal with no matter what. So maybe you have no choice in the beginning as a borrower. You have to do FHA just to get into the house. And what could you do to get out from under this mortgage insurance premium later? You could refinance into a conventional mortgage. You don't have to keep this FHA loan forever, but refinancing isn't free. As much as they like to lie to you that it is, the lenders will say, you can just do a refi and you don't have to pay any money today. Well, that's because they tack on those fees to the loan amount. So maybe you got your loan amount down to $160,000, and because you've refinanced, you're going to have a lower payment, but they also tacked on $5,000 to what you owe, and you actually now owe back up to $165,000 because they basically financed those closing costs they charged you for doing the refi. That's a whole other thing. Let's look at it. Look at that PMI slide a little bit. Private mortgage insurance, we're talking about on a conventional loan. It's additional security for the lender just in case the buyer defaults. The borrower pays for it. So when we get to Chapter 21 in a little bit, we're going to have to know who pays for what at closing. The buyer pays for PMI, right? The buyer pays for PMI. Loan to value ratio, dependent. It depends on if you're putting down less than 20%, then you have to have or pay for private mortgage insurance. And then the other thing about the lending process is the lender will loan you money not necessarily based on the sale price, but on what it appraises for. That loan to value ratio, we don't just determine the 90% LTV based on what the contract price is. It matters more what the appraiser supports. Maybe the contract price is for 800,000, but the appraiser does the appraisal and he can't justify or prove that the house is actually worth 800,000. He has to look, as we'll see in chapter 17 later, he has to look at similar houses that have sold recently, and maybe he can't find enough of those that sold for 800,000. He's got to appraise this house for 790. And so that lender is not going to loan you 90% of 800,000 because 800,000 didn't get appraised. It only appraised for 790. The appraiser could only justify that. So the lender's going to say, we'll loan you 90% of 790, not 90% of 800,000. So it's whichever's lower, the sale price or the appraised value. It's temporary because you can remove it once you get up to that 20% amount of equity. And with that, let's do a 10-minute break. I'll see you back here in 10. welcome back. Okay, so private mortgage insurance covers who? The lender. Paid by who? Who pays for it? You do. The borrower does. Yeah. Side note, spoiler alert. Anything that benefits the lender, usually paid by the borrower. He who has the gold makes the rules, the golden rule, right? So the lender has the gold you want to borrow. They make the rules that say you got to pay things and provide things in order to borrow. So this is PMI. When you see PMI, think, oh, that's a conventional loan. It's a mortgage insurance. That's what the MI stands for, mortgage insurance, private mortgage insurance. When you see MIP, you're going to think, oh, that's an FHA loan. The MI stands for mortgage insurance, but the P in that case is premium, mortgage insurance premium, but it accomplishes the same goal, basically the same idea. And MIP never goes away. You can't get your way to equity, get to the point of 20% equity and do away with that FHA MIP. A lot of acronyms. Let's talk about FHA loans compared to conventional loans. Why pick this instead of that? Because you don't have as much available for a down payment, or because your credit score isn't as good, isn't as high. So an FHA loan is insured by FHA, the government is insured by the government. Here is a hugely testable item, guys. Notice it says not guaranteed by the government. It's insured by the government. The FHA insures these loans to protect the lender and say it's safe to make these loans to that borrower who has less than good credit and who has less down payment. It's okay to go ahead and give them the loan. We will stand behind it and insure them. So if they ask you on the test, FHA loans are what? Private, insured by the government, or guaranteed by the government? The answer is insured by the government, specifically insured by FHA, Federal Housing Administration. But while the FHA insures these loans and provides some protection and safety, I guess, they aren't the one that you're borrowing from. They're not the ones originating the loan. When you see the word originate the loan, that means who's loaning the money. And so FHA is not loaning you the money. They're just standing behind the loan. Who's loaning the money? The lender. Probably the same lender you would go to ask about a conventional loan. Bank of America, Wells Fargo, mortgage brokers, as well as mortgage bankers. What's the difference there? A mortgage broker versus a banker. Well, think about a real estate agent like me who I'll sell anybody's house. Compared to going to Lennar Homes, if you go to their on-site model home, the only thing they're going to sell you is a Lennar home. So going to an agent that works for a builder is like a mortgage banker. You're only going to buy their product. A mortgage banker is going to sell you a Bank of America loan only. If you go to a mortgage broker, they can sell you a Bank of America loan or a Wells Fargo loan or any other lots of other kinds of lenders or investors that are loaning money. In fact, the way it's kind of structured on the back end, because lenders make money on the front end of when the loan gets approved and then also on the back end when they sell it, because all that works in such a weird way, a lot of times a mortgage broker can get a borrower connected to a Bank of America loan, for instance, cheaper than if they walked into the doors of Bank of America. Opposite of what you might expect. So I like to work with mortgage brokers, typically a good one, because they aren't married to a specific investor. They're going to probably do a pretty good job of saying, hey, borrower, here's your options. This one, or this one. Based on what you're saying you want to accomplish, I feel like one of these two are your best fit. You could certainly go into Bank of America or whatever your bank is, but you just want to get a quote from them and get a quote from whomever else. And as a broker, a real estate broker, you want your client to get bids probably from a couple different ones. And then you will help them compare apples to apples and see what the rate is here. And, oh, this rate looks better. Oh, but it's because they require 3 discount points. Wait a minute. Now that you know what discount points are, go out there on Google and search mortgage rates and just see what different places are offering as far as a rate. And I bet you the ones that have a significantly lower rate, or maybe even not so significantly, if everybody else is offering 7 and somebody out there is offering 6.75%, and you read the fine print, it's probably because they are charging a couple of discount points. Nothing's for free. You're buying your rate down. We'll learn more about that next chapter. So with this FHA loan, the lender who makes the loan, the lender determines the rate. The lender is the one who goes through this approval process that borrower must follow. And the mortgage insurance premium is what the lender is going to require if the borrower is putting less than 20% down. And that MIP is paid by the borrower, just like PMI is paid by the borrower if they were doing a conventional loan. But the main point here is FHA is insured by the government, through FHA. What are the upsides? Why is it good to get an FHA loan? Because a borrower can get away with having a lower down payment, can get away with having a lower credit score, and also can get away with spending more of their monthly income on the house. In other words, higher debt to income ratio. We did that math last night. And all you need to learn and be able to do for qualifying ratios is the conventional loan ones, the 28%, 36%, 28 on the front end, 36 on the back end. In other words, on a conventional loan, no more than 36% of your monthly income should go toward the house payment plus the recurring debt. That's conventional. For FHA, currently, 41%. An extra 5% more you could spend of your monthly income on the house and everything else is allowed. And I had a little old lady client, and she was like 87, wanted to buy a nice new house, fell in love with the floor plan. And she had income from various places. She had like a pension, and she had some retirement. She had 3 or 4 different things. The lender she was working with couldn't get her approved for the FHA loan that she needed to get because she could only put a certain amount down. And so we were like, I think her back end ratio, the math was coming out to about 42 or 43%. In order to afford the house she wanted. She picked the house before she got approved. That's the wrong order. You need to get it pre-approved first, figure out what your budget you're working with, and then go shopping within that budget. She let herself fall in love with the house, and then she's trying everything to squeeze into that house. And she had just bought a new car the year before, and I had to say, Ethel, one thing this lender is suggesting is that you turn the car back in. And she's like, well, it's like a $300 some payment. It would get me to that approval, but then what? Am I going to hitchhike? I got to go to work. I got things to go to. And she had a great point. We were able to find a different lender that could classify and justify one of her sources of income in a different way, so that it was actually considered 41% of her income coming in. So it slid in under that 41% back-end ratio requirement for a different lender because of their loan program. Different lenders have different requirements, and it all worked. So higher debt to income ratio for an FHA loan. You don't need to know it, but I'm just telling you, it's 41% right now compared to the 36 on a conventional. And then FHA and VA, as we'll see in a minute, you can't charge a prepayment penalty. That lender can't penalize someone for either selling the house and paying off the loan early or refinancing the FHA loan into a conventional one later, therefore paying off the FHA one early. They might be mad about it because you're doing them out of all those years of interest they were counting on, but they can't charge it. What's the negative? Already told you. That mortgage insurance doesn't go away, even if you get up to that 20% equity mark. And then here's VA loans. Finally, the third of the three. It's guaranteed instead of insured. Number one testable thing about VA loans, they like to test you on that the Veterans Affairs or the Department of Veterans Affairs, the VA, guarantees these loans, again, to make Fannie Mae more willing to buy and sell them on their marketplace. Again, even though they guarantee them, it's the lender who originates them. That's who loans the money. That's who decides on the rate, and that's who approves the borrower. The borrower is going to apply for it and have to get approved through the lender, whatever bank or brokerage it might be. VA also, side note, will make, let's say that military person decides they want to buy in an extremely country, rural kind of area, and maybe the lenders out in that county, they don't want to loan money because it's too far out in the sticks, too far in the rural area, for whatever reason. If that is limiting the choices of this lender, of this veteran or military person, the VA might actually make a loan in that situation because there are no other choices for this veteran to borrow money. So in that case, the VA might make a direct loan if it's an extremely rural place. No lenders willing or available to do so. What are the positives of a VA loan? The lowest down payment possible. VA loans are known for zero down payment. You are, again, no prepayment penalty, just like FHA. And they're even assumable. You can assume a VA loan, by the way, guys, listen to this, even if you're not a veteran or military. They are assumable by anyone, as long as that person qualifies financially. So the lender's going to say, these are qualifying assumable. Tell me your financials. Okay, then yes, you can assume this veteran's existing loan. Why would they want to assume an existing loan? Because the rate's lower than what you can get today, probably. The downside of a veteran letting their VA loan get assumed by a buyer is that it ties up and uses up their entitlement, their eligibility, their ability to borrow VA money themselves. So if they let you assume their mortgage, their VA mortgage, they can't go use the VA money themselves on the one they're purchasing until you've either paid off that loan yourself, refinanced out of it into a different one, and then freed up their VA entitlement again. The negatives, funding fees are paid at closing. That veteran's got to pay some fees for the privilege of having a no down payment luxury. And then there's an origination fee also paid at closing. So there are some fees. They're not walking in there with nothing, paying nothing. And then this last bullet point is talking about what I just mentioned. Only one VA loan at a time. You can't have more. You can have, so here's a testable question, guys. I've seen this. Can a veteran have more than one VA loan in their lifetime? Yes, but not simultaneously, right? So watch out for that. See that little twist like that, you're like, oh man, I answered too fast. But just kind of take your time, read the answer choices, and think about it. One VA loan at a time. They could have many, one by one, consecutive.
Hey, Neil.
Yes.
Hey, I have a question.
Sure.
So in regards to the VA, so as my understanding, this could be way wrong because what you just said doesn't align. But from my understanding is when you go to apply for a VA loan, they give you like a lump sum, right? So like, let's say you qualify for 500,000, right? You go to buy a house that's like 150,000. Well, you still have that 450,000 or whatever left, or 400 left over. So really, if they did, assign their original loan to somebody else that wasn't a VA, couldn't they still technically go use the rest of their allowance, let's just say from VA, like they qualify for that 500 and they bought a house at 150,
didn't use it
they
all
still
up.
have that difference to use. That was my understanding of how it worked. But
let me double check and I'll answer that next week. Well, that's a good point. I think most of the time people use the very most they can actually qualify for and get. So It's probably usually not an issue. It's not an option, but let me double check. Good question. I don't think you're going to need to know that level of it for the test, but I'll find out. A couple terms that go along with a VA loan is the appraisal is not called an appraisal. It's called a certificate of reasonable value. And here's the thing about VA and FHA loans. You can't just pick any old appraiser. Not just any appraiser is qualified to do an appraisal on an FHA or a VA loan. It's got to be an appraiser who has a certain certification. They've learned extra stuff and gotten tested on extra stuff, and they are now qualified and have a certificate that they can do those heightened levels of loans. Why? Because FHA and VA loans require more than just the value. They're a little bit like an inspection too. And these appraisers need to know what to look for, because, for instance, an FHA loan won't work on a house that has an old roof that's going to need to be replaced soon. They won't work if you have broken windows, or if you have paint peeling down to the wood, or if you doesn't have a range in it, an oven, or if it's got big holes in the wall, or things like that. Because again, you're trying to set this borrower up for success. So those appraisers need to know to look for those things, and they're going to look and do more work to make sure it meets the FHA or the VA standards. So you got to use a VA appraiser to do a VA loan, and that appraiser is going to prepare a certificate of reasonable value to make sure what's being paid is supported by similar sales, recent sales in the area. There is something called entitlement that veteran is authorized to get. They're entitled to, depending on their length of service, how long they served, and the way that they left the military, the type of discharge, determines how much they're entitled to borrow. And then the certificate of eligibility is the maximum amount that's guaranteed. It's the thing that says they're eligible to borrow the VA money. Another kind of loan, there's lots more than just these three, but another kind is a USDA loan, another government loan. This does not depend on military status. This actually is capped by income level. No more than a certain amount of income, because it's geared toward helping low to moderate income families or people. So you can't make more than a certain amount. Look it up for your area to see what that is. And it's guaranteed by the government through the USDA. They will also make direct loans if needed. The USDA will. USDA loans are for rural located properties, not in the city, but on the outskirts in the county, not the city limits. Again, low down payment, as little as zero down payment. The interest rates can be subsidized by the USDA. In other words, if the rates are at 7%, the borrower might enjoy a 6% rate, and the USDA will cover the difference, because that's the point of the program. The problem with USDA loans, besides the fact that I guess it's not a problem, it's good for the low to moderate income, but it's not for everybody, right? You can't make more than a certain amount for the collective household. But the other problem is you better get it early in the year, because it's a certain chunk of money that's authorized for it, and once it runs out, you got to wait till it's budgeted and allocated again for the next year. So it's inconsistent funding. It's not just constantly always available. It might have run out. Other kind of loans that you don't have to deep dive into, but just be familiar with. A purchase money mortgage, another word for that, it's a type of seller financing. So we've seen, I think, an installment land contract. That's a type of seller financing, and so is purchase money mortgage. Just to think seller financing. A bridge loan is something you would get temporarily. It bridges the gap of time between getting your current house sold and buying the next one. It lets you go ahead and get the next house, but even though you haven't sold your current house, it's a bridge loan for that amount of interim time. Let's see, a buy down is something we talked about with discount points, because you're buying down your rate. You could use discount points for this buy down loan, because you might hear it referred to as a 3-2-1 buy down, which would mean the borrower is going to get a really low rate the first year, and then the second year it's going to go up a little bit, and the third year to go up a little more, and then it's going to stay at a certain level after that. 3-2-1. As it graduates upward. and helps somebody who maybe expects to make more money in the future. And they're pretty confident about that. They can just get into the house now and have a lower payment, and it steps up a little and steps up a little. So a buy down enables that. How do they determine and calculate how much lower it is the first, second, and third year? With discount points, right? That kind of math. A reverse mortgage, you might, if you watch TV during the day when The Price is Right is on, you'll see commercials for reverse mortgages, because who else is watching TV during the day and not busy? People who maybe own houses that have no loan amounts anymore because they've lived there forever, like retirees. They have paid off their mortgage. They have complete 100% equity in the house. And what they're worried about in life as a retiree, advanced age person, is paying their bills without having to go to work because they've retired. And so some of them might be needing the income. And what they have is a house fully paid for that's not liquid. Remember, liquidity means you can get the money out. Your checking account is very liquid because you can just swipe a card. But the house, not so liquid. You got to wait, get it sold, find a buyer, get it closed, and maybe in 30 or 40 or 60 days, you might get your money. But a reverse mortgage lets you talk to a lender, and that lender will loan you money and send you a payment every month. Instead of you paying them, they pay you. But when they send you that payment every month, that equity that you have in the house decreases with every payment they send you. It's the opposite of a mortgage. It's a reverse mortgage. Eventually, the equity is going to run out. So that's why it's more commonly used for people that maybe figure they're not going to maybe be around so much longer. And it's sad to think about it that way, but it's like, well, I figure I'll live 10 more years and I have enough equity so that they can send me payments for 15 years. And so it's kind of a balance. It's like, how many more years will I need these monthly payments because I'll be dead eventually? And do I have enough equity in the house to get those payments? Frankly, that's honestly the idea. And that's a reverse mortgage. A package loan packages up personal property with real property. So it might be that you buy a model home from a builder and it has the furniture in it, and a package loan includes all that stuff, not just the real estate, but the furniture too, for instance. A blanket loan is like if you're a developer and you're making a 100-unit single-family neighborhood, and you get a blanket loan on the whole thing, but then you sell Victor a house, and so now instead of 100 houses within your loan amount, it goes down to 99. And then you sell Tima a house, and now you got 98, and then 97, 96. So that blanket shrinks over time, right? Because someone else is buying it and getting their own loan. You don't need it covered anymore. A construction loan is what you use to build a house from scratch. And it's set up so that you don't borrow the entire $500,000 the house is going to cost. The bank gives you, they see that you have house plans, you have general contractors involved, and you are the buyer. You're getting this construction loan, and they'll give you, like, say, $5,000 and say, well, this is for the first step in the building process, grading the land, digging the footers, pouring the footers, so that general contractor you hire is authorized to get that $5,000, spend it on that phase. Then the bank will send someone out to verify that it got done, make sure nobody just took the $5,000 and gambled it away or went to Mexico. Then what's the next step? Building the foundation walls. So here's another chunk. Oh, let's verify that you actually spent it and did it. Okay, good. Next step, putting on the floor and the walls. Next step, putting on the roof. Next step, wiring, electrical, plumbing, insulation, drywall, exterior siding, all the stuff. Eventually, that construction loan, which, by the way, once you take a draw, each of those chunks of money you're getting for paying for this work to be done along the way is called a draw. And you, the borrower, are having to pay the interest on that amount of money. So in the beginning, you're just paying interest on that initial few $1,000s. Oh, now I'm going to borrow an additional 5 or 10, an additional 7 or 8. And you're paying interest till finally, and hopefully 4, 5, 6, 9, 10 months, it's finished and you get a certificate of occupancy because it's all done properly and it was inspected along the way. And now you can convert that construction loan over into a normal, whatever kind of mortgage you want that you'll just pay normally for how 15 year, 30 year, whatever you want. So that construction loan is basically a short-term temporary just to get the house built. A home equity loan, it also lets you spend your equity, but not like a reverse mortgage. It's more of the bank will say, you've got some equity in your house. Let's say that you've paid down your loan and the house is worth $400,000 and you've paid the loan down to $200,000. So you have $200,000 of equity in the house. Well, the bank would let you borrow some of that. They're not going to let you borrow the entire 200. They'll probably let you borrow maybe 80% of that. So what's 80% of 200? They're going to let you borrow up to $160,000. And so they'll say, okay, you're approved. We've verified it's worth it. There's that much equity. And so here's a debit card, basically. You swipe that card, your equity goes down, right? And eventually you're going to use up that entire 160 or however much of it you borrowed. And it can just be sitting there available but not used. Maybe you just have that home equity line of credit, HELOC, by the way, HELOC, you might have seen that acronym, available because you know something's coming soon. And it's at probably a pretty decent interest rate. It might be cheaper, smarter to pay for life expenses with a HELOC than actually a car loan, for instance. How much does it cost to borrow? Maybe for a used car, those rates are a little higher. So if you already have a HELOC in place, maybe, or jumping on an investment opportunity because that money is right there and it's just pulling from the equity of the house. Or ideally, I think they were created to help you fund something that increases the value of the house. That might be the smartest thing to do with that equity, but it could be whatever you want, really. But those are various types of loans. A term to know is subordination. And so subordination is happening when a lower priority lien moves ahead of a higher priority lien. It's subordinate to that other loan. Typically, liens are in line based on the date of recordation. But usually the bigger mortgage loan, there might be two. Sometimes people have two mortgages, like either the primary mortgage to buy the house plus a home equity line of credit that we just talked about that's for less than. So the first mortgage is first in line in case of default, and then the second mortgage is second in line, subordinate to that first one. That's what subordination means. When it comes to the qualification process or the approval process, by the way, sometimes people refer to buying a house, they'll say, I got my pre-qualification letter, or they say, I got my pre-approval letter. Which is better? Pre-qualification just means that the lender had a phone call with you and asked you some questions about your financial business, and you answered them. They didn't verify anything. Pre-approval means they looked deeper. They looked at your credit score, maybe your credit report. It depends on the lender as to how much of a deep dive into your situation they actually look at when they do the pre-approval. And some lenders like to brag that their pre-approval letters are like rock solid because they've looked much more into the finances. But a pre-approval is better because it's based on reality instead of just somebody's answers. Sometimes people exaggerate. And what's that word? Oh, yeah, lie about stuff. So, yeah, pre-approval better than pre-qual. What is the process? Who are they talking to first? Your buyer, borrower. They're talking to what's called a loan originator or a loan officer. And when you get in this business, a lot of loan officers will reach out and say, hi, new real estate agent, let me take you to lunch. Or let me give you some candy, or let me give you something so that you listen to me and I get to become your go-to lender that you recommend to your buyers you're going to be meeting. So that's the person they talk to first. That person's going to help them make the application, apply for the loan. That person's going to collect the check that they have to write. The borrower has to write a check for an appraisal, maybe $400, $500, $600 for an appraisal up front. That person's going to charge and collect the check from the borrower for like a $50 credit report fee. so they can run their credit. And they're going to collect the initial upfront information about their income, their expenses. You need to have, here's what you need to have. Here's the list of documentation that the next person is going to ask you for. And all of that's done by the loan originator or the loan officer, the one that deals with agents directly and deals with borrowers directly. Once they've started the approval process, they're going to plug it all in the system. The next person involved is the loan processor. And that loan processor is someone who's not necessarily face-to-face with the borrower. They might email them from time to time, but you never really see the processor. There's somebody who is going in, turning on the computer and going down a checklist and saying, okay, borrower Stacy, we still need a couple of months of bank statements. We need a couple months of tax returns. Or years of tax returns. We need this and this and this. And, oh, look, the originator hasn't given me that. They didn't collect that yet. So they're going to email Stacy and say, hey, we still need this and this and this. Stacy will email it, fax it to them. The fax converts to email. And they will put this thing together, collect all this required info from Stacy, put it together into a loan package, make it nice and pretty and neat and easy to follow, easy to read. Why does it have to be nice and neat and organized? Because the next person in line is the decision maker. And that person is called the underwriter, like undertaker. I don't know why I said that. The underwriter is the one who gives the approval. That's the one you're trying to impress. That's the one that processor is trying to make life easy for. So that underwriter, she can say, okay, got all this? The appraisal come in? Yep. Okay, it appraised at the right value. All these documents, looks like the financials are in order. It's all ready to go. Credit score's still good. Oh, no last minute expenditures. They didn't buy a car 2 days before closing. Never let your client buy cars before the closing. The cars should come after the house closing. This very bad feeling when there's horror stories of buyers driving up to the closing in a new car and everybody's like, I guess we're going home today. Nobody's getting paid. This deal is dead because they threw off their what? Their qualifying ratios. Now they have a car payment that nobody planned for. So you learn to warn them from doing such things. I tell them, look, guys, right now, your financial advisor is that mortgage lender. Don't do anything. Don't even move money around or pay off any credit cards, or certainly don't close any credit cards or buy any cars or nothing. Don't even open a rooms to go card without talking to this lender person, this loan officer, and make sure it won't negatively affect your home purchase. Right? So anyway, that's the underwriting and approval process. They're looking at credit history, credit scores, housing expenses, comparing recurring obligations like we talked about, the qualifying ratios. They're looking at the property itself, seeing what the appraisal came in at. Did it appraise for the contract price? And they are making sure the title search done by the attorney came back nice and clear and there's no issues there. And then finally, if it all matches up and looks good, that underwriter gives it the okay and the loan is approved. A conditional approval, which means as long as the borrower doesn't do something stupid between now and closing day, we're going to make this loan. But if the borrower thinks, oh, I got approval, now I can go get a new credit card. No, you've trained them. They know better than to do that. A couple other things about this loan process is you want to lock in the interest rate at some point. How often do rates fluctuate? All the time. Rates can change randomly whenever, hourly even. So what you're expecting based on your conversation or the borrower's conversation with the lender today may not be the case tomorrow. And so it's almost a gamble. It's almost like betting and predicting something, predicting the future. It's like, how do I feel about the rates over the next 30 days between now and closing day? When I actually buy this house, do I think the rates are going to go up or down? And if for some reason, keeping up with what the Fed is doing, Federal Reserve, keeping up with what the economic situation is in the country and what's going on, election year and whatever it is that's happening right now, if you feel like that rate's going to go up before you're buying the house, you might want to go ahead and lock in a rate today. because by the time closing happens, the rates, in your opinion and best guess, educated hopefully, are going to be higher than they are today. Let's lock in. The lender will allow that. The lender will allow a rate lock. I'll honor the rate today, even though you're not closing for 30 or 60 more days. But you got to pay for the privilege. Pay for the rate lock so that we'll honor today's 7%, even though everybody thinks it's probably going to creep up to 7.5 in 30 days, if that's the case. So those people who are very risk averse and very scared about potential, like the people that would never dare possibly ever consider an adjustable rate mortgage, they would always get a fixed rate mortgage. They're probably going to be happy to go ahead and lock that rate in. And even if it comes down, they're not going to lose sleep over it. They're going to be so happy that they didn't have to worry about it going up. So it depends on the person. And really, it's not so much a conversation we brokers have as the loan originator is going to have with them. But that's what it is, a rate lock. So that rate is held at whatever the rate is now, locked in, probably for a fee. Here's the thing about a rate lock that can happen in real life. Let's say it's a rate lock for 30 days, and we get up to the day before closing, and something has happened to cause a delay in the closing, and the rate lock expires tomorrow. We're supposed to close tomorrow, but because of this delay, we can't close now until next week. So in addition to all the other problems that could cause, like who's going to live there, stuff's on the moving truck, are you going to give me the keys and let me move in early and all that stuff, now you got to worry, I got to get a rate lock extension for another week. That's not free. The lender charges an additional rate lock extension fee. And if it was the seller who caused this extension, do we think the buyer's going to expect that seller to pay for the fee? Probably want to. They're going to say, it's not my fault. I'm ready to go. You're the one who, for some reason, is causing this delay. We're going to expect that seller to pay this rate lock extension. And the seller may or may not be on board for that. And in real life, the seller might say, forget that. Screw you. I'm not paying for that. It's your problem. You're the one buying it. And this is a seller's market. And if you just walk away, I'll get to keep your due diligence and I'll go find, whatever. That's when you as a broker, or I as a broker, I'm going to ask, how much is that rate lock extension, by the way? Oh, $100, couple $100. You just put that on my tab. I'll cover that. Let's get everybody on the same page. Keep it nice and rolling along. And I don't have anything to prove. No ego trips. No principles of the thing, which usually means we're not at the money part yet. Principle usually means you haven't given me enough money to overcome my principles. That's a little pessimistic. But anyway, that's what it is. Like in real life, if it's a couple $100 and I'm making several $1,000 and I'm not going to offer it right up front, but if it comes down to it, we're not going to let a little rate lock extension get in the way of me getting a paycheck I've earned after 70 hours of work, and it all could blow apart because of some nonsense. Do you see? That's not testable. That's just wisdom after 27 years. I got nothing to prove except paying the bills, so I will handle an issue. Loan application procedures, we need to get pre-approved before submitting the offer. That's just good business. That's just smart real estate. Don't let some agents don't even put them in the car. Don't even start showing them houses unless they have a pre-approval letter. Business decision. Talk to your BIC if you can get away with it. And if you have enough credibility with that borrower client that trusts you to tell them how to do it properly, I like to use the phrase again, this is how I work, or this is how it works best. Before we go looking at houses, even though you're my best friend, let's make sure that you're in the right budget. Not the budget that you can max afford. I don't care about that number. I want to know the number that you are comfortable with. Because whatever you can most possibly afford is what the lender's going to tell you. They're trained to show you that number. But then I want you to back out of that and come down and think, what lets me also afford the Disney trip we like to take every Christmas, and also lets me sock away some money for the kids' college fund, and maybe we choose to homeschool and it costs a little extra for that, and whatever. Your preferences, your lifestyle. I don't want you maxed out sitting on a milk crate eating Beanie Weenies in that nice new $1 million house. I want you having a proportionate lifestyle if that's your thing as a borrower. So I have that talk to them with them. The lender's going to tell you the most you can afford, but then, Need to back down from that too, probably. Let's keep it sane. We don't want to be house poor. So that's why I want you to get pre-approved no matter who you are. Let's see what we're working with, figure out what you want to work with, and let's see what the market will let you have for that money and that price point, and then we'll go from there. It starts with a pre-approval letter. Here's a testable item. There is a 3-day period of time that the lender has in order to provide the borrower with an estimate of fees called a loan estimate. It is important to tell that borrower how much the loan is going to cost. It's not like one item. It's a bunch of different items that loan costs. And the lender is required to disclose those items and those costs to the borrower within 3 days of loan application. So what's loan application? That's what the second bullet here is. Loan application is when the lender has received the address of the property that they want to buy. Loan application. So the minute you've applied for the loan and you've said, I want to borrow this money to buy that house at that address, 3, 2, 1. Lender's got 3 days, and they'll probably do it the first day, but no later than the 3 days from that loan application, receiving that address, applying for the loan, they are required by law to tell the borrower, give the borrower a loan estimate document. The acronym is, wait for it, LE, loan estimate. So the loan estimate is the first thing within 3 days of application. Fast forward to the closing day. I'm going to give you a little heads up before we get to chapter 21. You'll learn it there. But fast forward to the closing day, we're going to close on this loan. And within 3 days prior to that closing, the lender must give the buyer borrower a closing disclosure document, a CD. And if, let's say, the day before closing, something changes about the interest rate or the payment, that lender, guess what? We're not closing tomorrow anymore. Because something changed like that in that kind of realm of information, a rate change, for instance, it's going to need to be a new 3 days notice. We'll be closing 3 days from that change date. So the lenders got really good at sticking to those dates. Before that, I was around when we had that transition. Everybody was sweating because up to that point, we would sometimes, quite frequently, lenders would change something on the day of, morning of closing. And that borrower didn't get to see the new disclosure till they were asked to sign it at the closing table. And that presented issues. Because then what are they going to do? Read all the fine print and see, oh, they slid a prepayment penalty in there. What else is in there that hurts the borrower? So it was a process put in place to keep all that nonsense from happening anymore. Full disclosure is the idea. And we'll look at it when we get to 21, but the LE, loan estimate, and the CD, loan disclosure, closing disclosure, look really similar. They're formatted the same. You can find if there's a prepayment penalty, it's in the same location in that form on the LE as it is on the CD. And that's for a purpose. That's so that borrowers, again, don't lose details in the fine print and end up agreeing to a loan that has some mystery charge that they weren't prepared for. If they get denied for that mortgage loan, just like any time someone gets denied for credit, whether it's a car or a credit card, if that's ever happened to you, rhetorically, you don't have to answer. It's happened to me before. At some point, you're going to receive in the mail, in writing, hey, sorry, remember, we couldn't approve you for this loan. And you're like, I know, you told me that last week. I'd just gotten over it. And here you are reminding me. No, it's law. It's required by law that loan denials have to be in writing. So you'll get that followed up there in the mail, or the borrower will. Let's go ahead and take our break, and we'll finish up this chapter. I'll see you back here in 10. Okay, can you guys hear me? Okay, good. Doesn't sound different or weirder. Okay, good. I'm using a wireless headphone, but there's a little latency that I'm hearing, so I might get over it. I might not be able to deal with that. As long as you're not hearing it, it's like a half a second delay. Okay, we'll see how it goes. Somebody asked in the chat. Okay, I'm bailing. I can't deal with this. 1 second. Still good? Okay, good. Better. No latency. How the ordering process goes. So for the appraisal, they ask, does the lender, or does who orders the appraisal? And it used to be that the lender would have preferred appraisers and they would order them directly. But the problem is that allowed some misbehavior, because if the appraisal came in lower, the lender wanted it to be the purchase price because they get to loan more money and earn more fees. So they'd say, hey, appraiser, you came in $8,000 low. If you want us to keep sending you business and using you for our loans, we'd really be happy if you would just reconsider your appraisal and bring it on up to the purchase price. So enough of that, basically loan fraud, took place that they changed the system. And so now a lender still hires, or the buyer pays for the appraisal. The appraiser owes the confidentiality to the lender, but the lender reaches out to a third-party company, ordering company, and they send the appraiser out. So the lender can't directly communicate with the appraiser as far as picking them. They get it paid for by the borrower. They say it needs to happen, and a third-party company says, hey, appraiser, you want to take this one? It's over here at this address. And the appraiser will decide, nope, that's too far. I don't want to take it. Or, okay, next appraiser, you'll take it? Great. And that appraisal is done, and we'll talk about that process later. Okay. There is something called the Truth in Lending Act. The Truth in Lending Act. It's exactly what it sounds like. It requires that lenders tell the truth and tell borrowers what they're really going to have to pay. That's the main purpose. It also has a requirement of brokers. A lot of the requirements are that the Truth in Lending Act is over lenders, but it does have some requirements that we real estate brokers have to follow, which is along with what the lender has to do. And one of them is under what's called Regulation Z. It says that, by the way, if you were going to respond to an ad to buy a car, what would get your attention the most? An ad that said, this car has air conditioning and heated seats, or an ad that said, you could buy this car for $1,000 down and $200 a month. Same for houses. It works the same. Buyers get excited. It's great, and you'll get responses, and people notice ads where you tell them what a payment might be. And that is allowed. You're allowed to run ads for your listings and get a lender maybe to prepare a loan sheet to show you how much could it be if you put 20% down, maybe paid a couple of discount points, and at a current rate of 7% for a 30-year term, here's what the payment would be. And then you could run an ad for your listing and said, you could own this home with a payment of $2,100 a month. That is allowed. But Regulation Z of the Truth in Lending Act says, yes, you can advertise a payment or an interest rate like that, but that's not all you're allowed to put in the ad. You have to tell them the whole story financially. If you advertise a payment, you also have to tell them, but that payment is only possible at a 7% rate for 30 years with 2 discount points. You got to give them all the info that affects that payment. You can't just cherry pick one thing. You can't only tell them 7% rate or only tell them $3,000 payment. The Truth in Lending Regulation Z says that trigger terms are things like the interest rate, the loan's annual percentage rate, interest rate, finance charges, the number and amount of payments. Basically, 30-year loan is 360 payments. And the total amount financed. You are allowed to use trigger terms in your advertising. Yes, you are allowed to, but only if you tell all of this other stuff too. They can be in the fine print, but your ad can't just show a payment, for instance. That's what this trigger term under Regulation Z is talking about. Don't let the test trick you. Don't fall for this little decoy tactic and they say, are trigger terms allowed? And you're thinking, trigger terms are bad. No, can't be allowed. Wrong. Yes, trigger terms are allowed. What are they triggering? They're triggering that it's not enough just to put in that one number. You got to disclose the whole situation. So if you disclose a payment, you have to also disclose this list here. It could look like this. Seller, sometimes you'll see ads that look like this. Sorry. This slide are not trigger terms. These are not trigger terms. It's okay for you or a lender or somebody selling a house, builder, new construction, to say the seller's going to pay the buyer's closing cost. That does not trigger the requirement to disclose, and it's at 7% interest for 30 years and it has 3 discount points. These aren't trigger terms. You can advertise any of these phrases about the property and not have to disclose all that other stuff. HOA dues are X dollars a month. Not a trigger term. Credit report fee included. Builder will pay for it. That is also not a trigger term. So trigger terms apply to loan terms, not this other stuff. Here's other stuff that is not trigger terms. Low down payment, no down payment, low payments, no payments, generic phrases like that. General financing terms are allowed to be disclosed without requiring the other disclosure of everything else. So it's only going to be a trigger term if it's one of these things related to the payment, essentially, in which case you got to tell the whole story. But if it's one of these other types of things, these aren't specific payment related things. Therefore, you're not required. They're not trigger terms. You don't have to disclose all of the whole story. So that's Regulation Z. And that anybody who's running an ad involving mortgage terms has to follow it, including we as brokers. RESPA it's another big acronym, stands for Real Estate Settlement Procedures Act. RESPA, Real Estate Settlement Procedures Act. And it's the thing that protects consumers from lenders being predatory and abusive and hiding things in the fine print or not even providing the information at all. Before all this stuff was put into place, lenders could advertise, hey, that guy down the street does a 6% interest rate. We do a 5% rate. And the borrower wouldn't find out that that's only possible if you pay 7 discount points to get down to that rate. By the time that happens, it's the day of closing, and they're much more inclined to just go with it anyway. Even though they were lied to and led astray, do they really want to empty the moving truck? They're too far into the process. Do they really want to let down their family? It's just a little bit more money, a couple more thousand than they were prepared for because the lender hid it and was deceitful. Maybe they walk, maybe they don't, but it might cost them a lot to walk away at that point. So RESPA was put in place to be full disclosure. Involves a lot of things, including disclosing using the loan estimate and the closing disclosure. Another legislation that's in place that protects consumers is the Fair Credit Reporting Act, which allows everybody to see their credit report and get one free a year. One free a year. If you haven't got one in a while, go look it up, Google it, and get your free credit report so you can see what your situation is. It's better to do it before you're ready to purchase something so that you're in a good shape. Odds are there's incorrect information on there that you had nothing to do with. It's not your fault. Better to figure it out now and work on getting it cleared off, taken off, fixed. Even if it is your fault, having a chance to fix a thing just because you negotiated paying off a charge off or something, just to put yourself in the best possible light and keep that score and credit history nice and good, nice and healthy. So you're ready to buy a car, buy a house, all that's not going to hinder you from doing so. Fair Credit Reporting Act sets the reporting standards. The 3 basic credit reporting bureaus have to follow it. Establishes consumer rights, allows you to correct errors, and most of the negative info that might be on your credit history is going to last 7 years. If it's a bankruptcy or a foreclosure, that can last longer, like 10 years. Equal Credit Opportunity Act. We're going to learn in Unit 19 about the federal fair housing categories. I think I might have given you a little heads up. The acronym to those is Fresh Corn. The E and the O in Fresh Corn stand for equal opportunity, but all the other letters are the 7 federally protected classes that in real estate we're not allowed to discriminate against. We can't give a better rate to someone in any of those classes than someone in a different class, whether it's race, religion, color, national origin, familial status, that's 5, sex, or handicap, right? So the Equal Credit Opportunity Act adds 3 more protected classes, and it's what a lender is not allowed to discriminate against either. On top of those 7 things, the lender has 3 additional protected classes that they cannot discriminate against, and so one of them is age. And you're maybe thinking, big deal. Of course not. That would be terrible. Why would they? But think about it. A lender is being asked to loan someone money for quite frequently a 30-year term. And I have a friend whose grandmother died at 105 years old. And she bought a house at 95 years old. She paid cash. But the Equal Credit Opportunity Act with the protected class of age says that if she had chosen to get a 30-year mortgage at age 95, the lender could not consider her age in denying her that loan. It's illegal for them to turn a loan down because she's 95, because they're thinking, is she going to make it to 125? Maybe not. So illegal. Also marital status. Oh, we can't make a loan because you're just the wife, just the husband, or you're not even married at all. Whatever. Illegal. Marital status should not affect loan qualifying, loan approval. And then, this person makes income because the government gives them a check. They don't actually go out and work a job. They're getting public assistance in some way. Cannot discriminate and deny a loan because someone's income, either all of it or partially, is from public assistance. So these three protected classes that a lender is not allowed to deny a loan because of. Last couple of slides are just recaps, study suggestions. We've learned all this stuff now. And so remember that the Federal Reserve controls the money supply in the economy. The primary mortgage market is where loans are made directly to consumers. The secondary market is where those loans are packaged up into big bundles and bought and sold in order for that money made from selling it to fund new loans being made in the primary market. The secondary mortgage market participants are, the marketplaces are Fannie Mae, Freddie Mac, and Ginnie Mae. Ginnie Mae being the government one. And Ginnie Mae stands behind the FHA and VA mortgages so that they can be traded and bought and sold on the Fannie Mae market. Otherwise, Fannie Mae wouldn't touch them, wouldn't allow them to be bought and sold if it weren't for Ginnie Mae being insuring or guaranteeing, right? And then the different loan types. Speaking of that, a conventional loan type is neither insured nor guaranteed. It's private, not government related, because it requires better credit and more down payment. And so lenders are a little more confident that those borrowers are going to pay them back. FHA, insured by the government. VA, guaranteed by the government. RESPA, the Real Estate Settlement Procedures Act, protects consumers in residential loans. Regulation Z, loan terms must be disclosed in full, no hiding things. Trigger terms, if you disclose one item that's a trigger term, you have to disclose all the rest of them. And it's payment related. Payments, rates, duration, type, amount being borrowed. And then lender protected classes include age, marital status, and public assistance income. All right, that is the long journey that we call chapters 14 and 15. Let's go on into closing the transaction. There we go. Unit 21, closing the transaction. And in your syllabus, we're talking about, what are we talking about? Oh, yeah. 12. Should be 12, I think, if this is right. And it's about an 8-hour duration, so we're going to talk about it through next week. Let me tighten that up a little bit. Okay. Our objectives here, closing procedures, right? Very important. This is half of one of the post-licensing classes. Post-licensing 302 is about contracts and closings. So I typically in the past have taught this as 4 full day pieces, like 9 to 4 or so, 2 days, Thursday, Friday this week, 2 days, Thursday, Friday next week, for instance. Not on the schedule to teach any right now, but that's how we do it. And usually the first 2 days of the first week are talking about contracts and how to do offers and what makes a contract a contract, deep diving into what we learned in 9 and 10. And then the second 2 days of the second week are closing stuff, what we're learning right now. And I like it the most because that's where the money is in real life. We're not making any money unless we're writing contracts and getting them closed. So this is a very important chapter for a couple of reasons. Number one, it's an 8-hour segment. Number two, it applies directly, much more so than a fee simple, defeasible, determinable. You might never see that phrase in real life. And if you do, you're very quickly going to say, go talk to an attorney about that, not me. You're just learning it for like baseline fundamentals. Here, pretty much this entire section is real world applicable stuff. So the application, a lot of it, let's look at it in the syllabus, by the way. Syllabus 21. Oh, there we go. I think we're close. Yeah. Here we are. Let me flip over. Section 12 of the syllabus is chapter 21 of the Yellow Book. It's an 8-hour course, and look at that. Pre-closing procedures, level 3. A lot of this stuff is level 3. That's how important, that's how detailed and deep dive we're going with this. And I'd say between now and next week, if you haven't already, read this a couple of times. This is one of those types of sections in the syllabus that gives you a lot of details in it. They're not asking or just putting in like terms that you have to go look up somewhere else. They're giving you the stuff right here. We finally get to some terms here. So I'd say try to write them from what you've read, try to remember it and think about, even just guess, and then go look it up and see what it really is if we haven't yet covered it. Guessing and getting it wrong and then finding the answer is going to stick in your memory better than just reading it directly from the book. So be wrong as much as you can in your prep time. In your study time, it will hold a bookmark in your brain better. And so there we go. I've only seen just finally we're at a level 1 item, and then over down here a level 2 item, meaning level 1, just know the definitions. Level 2, be able to compare and contrast. But level 3 is the most thorough knowledge of a thing. And we're in a chapter that's most entirely level 3. So there we go. Take a look at that when we get out of class between now and next week so that you're fully ready and looking for what the syllabus wants you to know about this topic. The RESPA stuff, we'll deep dive into Real Estate Settlement Procedures Act, pre-closing procedures, what goes on before closing, the closing procedures themselves, the settlement statement, also known as the closing disclosure if it's a loan, the HUD-1 form if it's cash, broker responsibilities. I'll give you the short version of that. Anything that came out of the contract, any dollar amount, money-related stuff from the contract, we are responsible for double-checking on the settlement statement, making sure the attorney did it right, or the paralegal, because that's who was doing most of the prep work there. And then calculations. Oh, no. We just had to do some math in finance, and that was probably your least favorite math so far, if I'm guessing. Well, we're going to be doing a lot more math in this chapter. Get ready. Buckle up. This is the math that the paralegal is doing in real life. But again, we have to back them up, follow up, and make sure they did it right. They're not like using an abacus. You know what that is? It's like a millennial, thousands of year old bead kind of a device that they used to add instead of a calculator. Nothing like that. They're not doing calculus or some advanced math. It's just pluses and minuses and multiplications and divisions. And they're plugging it into like an Excel spreadsheet, a specialized one just for closings, but they could put it in the wrong field, which now makes it a plus instead of a minus and ends up charging the client more or something instead of giving them money back. So we, as the broker for that client, need to make sure all those figures are in order. And so in 302, post 302, you actually have to fill in the blanks of the actual closing disclosure. Let me show you what that means. The good news is you don't have to do that in this class. You do it later, but not now. Here is what the closing disclosure looks like, and I'll show you the loan estimate later, and it looks very similar. But up here, we know it's a closing disclosure because that's the title. That's how it's labeled. But we can see the loan amount is mentioned, the amount that's the rate is going to be, and then how much does that mean for the principal and interest. And then is there a prepayment penalty for this loan? Apparently there is. And then a balloon payment, meaning are all the payments going to be the same except the very last one? And if so, yes or no? In this case, no. And then it breaks down the payment even more. It says, well, the principal and interest is $761, but then also for the mortgage insurance, we just learned that tonight, PMI or MIP, depending on the type of loan, it's an additional $82 a month. And then the escrow for taxes and insurance is an additional $206. When you add all of that up, this borrower's PITI, PMI, all of it together, $1,050. Who's ready to sign on the dotted line for this loan? And then they talk about the taxes, insurance, and assessments portion of this is $356.13. So it breaks it all out. It makes it very obvious to that borrower. In this case, they're even saying, oh, look, from years 1 through 7, you're going to have to, as long as you make your regular payments, and we're assuming it's going to hit that 20% equity, the mortgage insurance is going to fall off at year 8. and your payment's going to reduce by that amount. Then at the very bottom, it says the entire closing cost paid by the borrower, $9,712. And therefore, how much are they going to need to bring to the closing table, including their down payment? $9,712 plus more money to total $14,147. And that is a CD. All these items are always on the same place, no matter who you're borrowing it from. Wells Fargo, Bank of America, anybody. They all have to use this same format. This is the one that's bigger. This is the second page of the closing disclosure that you don't have to manipulate so much in this class, but you will in Post 302. And this is real world, what you're going to see when you're helping somebody go into closing, working for them as either a buyer or seller. It's the big line item showing every dollar and cent being paid or received by the buyer and the seller. This page, just to kind of give you the overview, we're not getting too deep dived here. This is all expenses. There's no credits. Nobody's getting any sort of credit that they might be receiving in this closing is not going to show up on this page. It's all expenses, and they've got it divided up into the buyer's side. They're calling them the borrower, and the seller's side. Buyer on the left, seller on the right. And you can see most of them are buyer expenses. Doesn't mean it's going to add up to more necessarily, but there's more items. Seller's got some basics. They've got excise tax called transfer tax in this case. They've got, looks like a warranty they're paying for, or maybe, what is that? Oh yeah, they already paid for it. Commission is the biggest line item probably, typically. And then it's all totaled here at the bottom. And this number will go over to the next page as a debit. It's another term you're going to need to know for this chapter. A debit is an expense. Anybody ever take a formal like tax class or accounting class in college? Forget what you learned if you've taken it. Debits and credits are a little more, they're different in those classes. Debits and credits for this class and in real estate are more like just managing a checking account. A debit is the fact that you had to pay subscription to Netflix. That money went out of your account. It was a debit to your account. A credit means that maybe your cousin Venmo'd you for that lunch that you paid for because they forgot their wallet. And so they Venmo'd you $20. And so $20 came into your checking account. It's credited to your account. That's all we're talking about with debits and credits on this closing statement. And so this entire page are all debits. And so if we look at the top, the buyer expenses or debits, this whole first top quarter of the page is all about the loan fees. The various loan fees. We'll look more closely at them later. Then this bottom half of the page or quarter of the page, looks like half, are other things like recording fees, the property taxes, their portion of them, homeowners insurance. You got to prepay the entire first year's homeowners insurance policy when you buy a house, and a couple other things. So that's this page. All expenses, also known as debits. And then the total of what's on this page for the buyer and then for the seller comes down to this final page. This one is divided up into 4 quarters. There's a square here and over here and over here and over here. And it's in a chunk of things that are all payments or debits required from the buyer. And then down here are the credits the buyer might be receiving for various things. Over here, it's swapped. Up top is the stuff the seller is getting, the credits to the seller, and then the down block here for the seller are the expenses the seller is expected to pay. And right here is the one that was the total from that other page. It shows up in this block as a seller debit total from the previous page. And then over here is the buyer debit total from the previous page. So just a little little glimpse of what we're going to kind of touch on. The rest of the pages of the closing disclosure are more disclosure types of fine print type thing. So that's it. That's what that looks like. There we go. Come back to here. So those calculations are what go on those pages. That's where those calculations will show up in the real world. We don't need to put them on those pages in our class in this pre-licensing, but you will in post. So what happens? Contract gets signed. And you know, on HGTV, everybody's popping bottles, drinking champagne, and celebrating as soon as they get that offer accepted. And I'm cringing because I'm like, there is a mountain of tasks and possibilities for this thing to fall apart between you and an actual check. So put the champagne away. I get it. It's TV, whatever. There's a lot to do. This is the part where a good agent shows their worth. And this is the part that nobody thinks about when they think real estate agent. They're thinking our only value is helping you find the property. And they're like, well, I found it myself because I drove by it, or Zillow told me where it was. So what value are you? My value is from here to the end line, the end zone, because there's a myriad of things that could go wrong. And I've already seen them 1,000 times, and I know how to fix them quickly. I know who to help and get help from to fix it so that you can get past it. And so a client who runs into somebody who isn't as well-versed or hasn't had the experience or had a few or doesn't have enough guidance, they don't find out that their agent is negligent and lacking in this knowledge of getting them through all these hurdles until the hurdle has emerged. And that's when they realize, oh, I'm working with the prettiest, handsomest agent, but not the one that can get me past this sticking point necessarily. So it doesn't matter if you're 20 years in the business or 2 months in the business, as long as you have guidance and somebody like a BIC to lean on. Some people that are brand new or even been around a while don't have quick access to the answers and the guidance and the mentorship and the BIC. That's good. And when I'm teaching post in the past, I've had people who at a break ask me about something they learned or didn't learn from their BIC, and I find out their BIC is kind of terrible. I don't tell them that. I'm just like, oh, sorry that happened to you. Well, here's the answer to that situation. Then when they schedule to take the next post from me 2-3 months later, I noticed that they are at a different company because they realized I wasn't getting the support I needed. So whether you're new or experienced, that's irrelevant. I'm not picking on new people. I'm saying, long as you have the resources to get the answers, to get your client through these hurdles and obstacles, that's what counts. And some people don't. Some people just don't even care. They're just like, oh, sorry that happened. Too bad for you. I think a good agent does their research, either from experience or from a good person guiding them, and prepares the client for the possible issues. So that if those issues arise, the client's like, oh, she already warned me of this. Here it is. No big deal. But if you don't give them that heads up and the thing happens and it's just like, oh my gosh, this whole thing's going to fall apart. No, it's okay. We've seen this before. We can get through it. And you can fake that. Since you're new, you can just say, standard answer, no big deal. Let me check on a couple of things and we'll get back to you and we'll figure out how to get you past this. Right? You don't have to show the panic in your eyes that you might be feeling in your belly. You can just assure them, look, it's all been handled before. I'm sure we can work it out. Let me see what the issue is, and we'll get through it. That contract gets signed. There's a lot of work to do. And it starts with the pre-closing procedures. For one thing, we got to get this deed created. It's got to be created and made. Who makes the deed? Who writes the deed? Out of all the parties involved, who creates the deed? There you go. Yeah, the attorney. That's one of the things that they're going to do. And what is the document they look at in order to let them know how they need to write that deed? What's the main document they're referring to? Yeah, because we learned that the contract is even more important than the deed because the contract informs the deed. Full circle. Came all the way back around to something we saw a couple weeks ago. Yeah. Let's see a question. What happens when you get to the end or the closing and they do not have the closing costs? Do you mean like who doesn't have them? Meaning people don't, like the parties involved, the buyer doesn't have enough for the closing costs? Is that what we're talking about? Well, you would learn before closing. That would have been confirmed before closing unless they spent the money. It was already seen that it was in the account and somehow along the way they spent it. Thank goodness, no. That has not happened. What the thing that's probably more likely than that to happen is somebody buys something on credit that messes up their qualifying ratios. One time, my clients were from Florida. We picked it. We got under contract. They flew back to Florida. The next week, I'm checking in with him, seeing how things are. And he's like, oh, she had to go to the hospital. And I'm like, oh my gosh, is she okay? The wife was in the hospital. And he's like, oh yeah, no, it's no big deal. She's just getting a boob job. And I'm thinking two thoughts. Number one, make sure you look at her from the neck up the next time you see them in person. And number two, did you buy them on credit or did you pay cash? Are the boobs going to keep this closing from happening? And I'm like, oh my gosh. I've never prayed for somebody else's boobs more in my life. Thankfully, they did it in a way. They paid cash. It was no big deal. But I literally did think, oh my gosh, is this going to mess up their qualifying? And I actually said, we might have this. I'm not getting in your business anything other than how'd you pay for them and run it by the lender. Make sure we're still okay there so that you don't have some crazy thing that keeps you from closing on this house. So what's happening? The attorney's writing the deed to get it over to the buyer eventually. There's got to be consideration in exchange for that deed, meaning the purchase price to go from the buyer to the seller. Then all the various funds that we saw on those statements a minute ago or those sheets, the money coming in, the money going out need to be accounted for and disclosed and dispersed. Because that lender is the main one who cares about that closing disclosure, and they need to know what money is involved here. Best way to terminate contract and agency agreements, remember, is to have a successful closing. And this is what we're talking about. This is all part of a successful closing. We've already learned this part. The difference between a closing and a settlement, the settlement is when the papers are signed and executed, execution of documents to transfer the property, and those documents are delivered to the closing attorney. So the settlement involves the people, like a voidable contract, by the way. Settlement's about the people signing the paperwork, and then the closing happens when the people are gone. The buyer and seller have left the building. The attorney now is making sure there's no additional liens that happened at the last minute so they can record the deed. Because literally what that attorney's going to do once everybody signs all these papers, takes an hour or so, by the way, for a buyer probably to sign all those documents for the lender. And that attorney is going to make sure, do one more quick title search, make sure no other mechanics liens or any other kind of liens went in against that property. Because if they did, it would need to be dealt with, handled. Long as it's all clear and nothing additional has come along, they're going to hurry up and record that deed. And now we're good. And now we can give the keys to the buyer and the check to the seller for their proceeds, and then most importantly, the check to us for all our hard work. Deeds recorded at closing. The buyer receives possession. The seller gets their funds. The brokers receive their commission. So closing is more about paperwork, while settlement is more about people. When are things happening? Well, ideally, the keys and therefore the possession shouldn't happen until after it's been recorded. The deed has been recorded, constitutes it having been closed. Means it's been closed. It's not closed until the deed's recorded. There are some exceptions. Again, I think we mentioned it. The buyer might ask and be allowed to move in early. They've signed the papers, but it didn't get recorded yet because Friday after 4 is when all the signatures finally happen. But the Register of Deeds office is closing at 4, and therefore we can't record yet until Monday. So the buyer's stuff is on a moving truck, and they're asking with puppy dog eyes, can't we please just move it into the garage? Or can't we please just go ahead and move in the house? And that's allowable. They can get the keys then, as long as the seller understands. Seller, don't turn off your insurance coverage yet. Buyer, get some tenant renter policy for your insurance for the next 2 or 3 days so that your contents that you're putting in this house are covered. You don't need the house insurance yet because the seller is still the owner. So those are issues. But for the most part, possession and keys don't transfer until that closing has happened. The first step in this under contract process is this due diligence period of time. And the reason it's named that is because you're doing your due diligence to determine if you want to what? Actually close on it or not. Whether or not to proceed is the idea. It's not called due diligence period because of the due diligence money. Because if it were, that'd be a terrible name. It really should be called, if it were about the money, it should be called the earnest money period, because that's the amount of time that the buyer might get their earnest money back if they choose to back out. It's called the due diligence period because that's the time they're doing their diligence to make sure they still want to buy it. Having it inspected, having it appraised, having it surveyed, anything that could cause it to not be a thing they still want to do. So they're investigating the property, making sure they want to keep going, buy it or not. And the deadline of that due diligence period is one of the two time is of the essence dates that is in the contract, the standard contract. So 5 p.m. on the date put in the blank is when the buyer needs to make sure they are cool with how all the inspections came back and whether the seller's willing to fix something and has signed off promising to fix it. What do we need to have accomplished by the due diligence deadline, 5 p.m.? Need to have either the fact that no repairs are going to be made and the buyer's okay with that, or the fact that the seller's willing to do some repairs and they have signed a piece of paper that promises it. And now that buyer has something to hold them to after the due diligence deadline, because the seller doesn't have to have it fixed by then. They just have to sign something promising to fix it, if that's what the buyer requires to move forward. So what is happening during this due diligence period that we need to make sure the buyer has confidence that, yes, okay, I'm still happy with this deal and I will move forward beyond the due diligence deadline on toward closing after making sure things are good. What's happening during that period, they're picking an attorney, because that attorney needs to go ahead and start doing the title search. That needs to have enough time for that. They've hopefully picked a lender and gone ahead and applied for the loan, because that loan process is going on in the background while inspections are happening. And then the inspections are happening. That's the part where you, the broker, are most involved, because you're maybe making suggestions on an inspector to hire and maybe showing up for all or part of the inspection so that you can be there and see the damage done by the termites and help your buyer understand it. And so you can get ready to maybe ask for it and negotiate those repairs. A survey, so that anything the survey brings back and lets you know might be a problem, like, oh, surveyor showed that it's a floodplain property. It's in a flood zone. And so that's going to require flood insurance. That's more than the buyer was expecting to have to deal with. And it's another $200 a year or a month or whatever. So get that survey done within the due diligence period. And then they need to also, sometimes they don't think about this till the very end, but they need to go ahead and shop for homeowners insurance. It might be that because of the history of this property, the homeowner's insurance company is going to charge a higher rate or not insure it at all, because maybe there's some kind of crazy recurring issue with water intrusion or something. There's a history. When we get to the insurance chapter, there's a way to look up the history of the policy, of the coverage, like history of the claims. That's what I'm looking for. The claims against the property, the insurance claims, called a CLUE report, Comprehensive Loss Underwriting Exchange report. And that's one of the things the insurance company is going to look at. Let me see the CLUE report for this property and see if they had any sort of major issues that we need to know about before we agree to insure it. So the buyer needs to go ahead and shop and pick an insurance company so that if there is an issue that they can't get insurance, they probably don't want to buy the house. Or their lender won't finance the house because the lender is going to require it to be insured. So all that's important to do during this due diligence period. And again, anything they care about that could cause them to not want to buy it. There is no loan contingency in the offer to purchase and contract. We've talked about that. There could be, it can be added, but if you just use only the standard offer to purchase contract form 2T, that does not have one built into it. Which means if the buyer's loan does not get approved, the buyer's not getting any money back, possibly no money back if they've not discovered this approval didn't work until after the due diligence deadline. They're not getting their due diligence back, but now they're also not getting their earnest money back. So all the more important to try to get as strong of an idea from the lender that they're going to actually give them the loan while we're still in the due diligence phase. That way the buyer can say, oh, looks like the loan's not going to go through. Let me go ahead and back out now. So at least I can get my earnest money if I need to walk. In real life, quite honestly, quite often the loan doesn't get approved during the due diligence process. You just want to start as soon as you possibly can so that lender has time to go through their motions to get as strong of an idea that it's going to not be a problem. Frankly, though, you should have already talked about this with the borrower and have a good enough, strong enough pre-approval letter that you feel like it's not going to be an issue. The loan approval is probably going to be okay. Good question. Is there some reason to use and look at a clue report before a contract? If your buyer cares and is worried about a certain thing with that house, maybe we saw some sort of red flag when we looked through it, like those watermarks in the basement walls. And we're like, seller's not admitting to anything down here. Let's see if there were any major insurance claims on this property. And just like a credit report is free every year, a clue report is free to a homeowner every year. And so the best method here is to say, hey, listing agent, would the seller go ahead and pull their clue report and share that with us? We're thinking about making an offer. So if that was a concern for that reason, that'd be probably the way to go. Okay, so what's next? What is the buyer looking for? Well, we know about inspections. What else? We talked about insurance, appraisal, survey. If it's on a septic system, let's make sure it perks for the size house that's in there, because it might not. Maybe they've added a bedroom, but they didn't do anything to modify the septic system, and so the house still perks for a 3-bedroom home, but it now has 4 bedrooms. If the appraiser reports it back to the lender that this house is now a 4-bedroom house, and then they see that the septic permit is only perking for a 3, might have a problem with that lender wanting to loan money, right? Lender might say, oh, we need a better septic system that can accommodate 4 bedrooms worth of people instead of only 3. So all the more reason, get that a septic inspection maybe. Verify the septic permit, perks for the right number of bedrooms of the house that the lender is using as collateral. And then we have a lot of termites in our temperature, in our climate here in North Carolina. Florida has bigger ones than we do. But it's like heart problems. They're pretty good at how to handle heart problems in the medical field. You can have a pretty bad heart and still survive quite a few years because they kind of know what they're doing. Termites are known. We know what to do. We know how to treat them. The process of keeping them out of there. And it's just a matter of treating for the termites if they've shown up, combined with fixing the damage they might have done. So, but that's another inspection you should get, is a not just termites, but wood destroying pests might also be anything that eats wood. Carpenter bees, burrow. If you ever see holes about 1/2 inch in diameter, it's probably a bug of some sort or a carpenter bee that eats that wood and goes down into that hole. And eventually enough of those, and I've seen if one bee gets in there, a lot of them are starting to eat that wood. And I've seen, looks like bullet holes or something. It looks like there's a whole bunch of them because it's maybe a property that's on the lake and you don't go that often, so you haven't treated and pushed those bees away. So it could be that, could be powder post beetles, any kind of bug that eats wood. Need to have an inspection to see what the status of the structural wood components of the house is. And then the zoning of the property. Is it being used for its right zoning? Are there any zoning issues? Government regulations, flood zone, flood hazard. Does it flood to the point where the water gets into the house sometimes? I sold a house like that and the seller disclosed it, and I told everybody too, and the buyer who bought it ended up actually being a real estate agent. She was her own agent, buying it to live in herself. She liked the house and the property because it backed up to land she already owned. So she already knew about the flood thing. But I'll see her on Facebook sometimes, and every couple of years we get enough rain several days in a row, usually in the summer, that her house, to walk into the house, you go up several stairs, and it's probably 4 or 5 feet above the ground. Like you drive in the driveway and you're going up some brick stairs to get to her door. Well, the flood covers her entire property. It doesn't get into the house, but her heating and air system, the main unit, is in the crawl space. It usually gets blown because it gets flooded, and she has got to call it into her insurance, and they send somebody out and replace it. And I don't want to live that life, but she's comfortable with it and she does it. And it's just part of it because it's in a 100-year floodplain. Doesn't mean it's only going to flood every 100 years. It means it's more prone to flooding than other property might be. And she'll show pictures of the entire backyard covered in water, and the white vinyl fence, a couple of the panels knocked down, and the patio furniture on the other side of the yard upside down because it got washed away. And let's figure that out before the buyer's committed to buying it, right? During this due diligence period. Utilities and access. Sometimes the buyer will say, show us the last 3 months average utility bills. Is there anything crazy about the utilities that we need to know? Is it really a lot of power this property uses for some reason? Streets and roads. What do I mean by streets and roads? What are we asking or thinking about when we see the term streets and roads that buyer needs to know? Yeah, you got right to it real quick. Public maintained or private maintained? Because that could lead to a lot of money down the road too. And are there any underground fuel storage tanks? Or above ground, but definitely the underground. We need to make sure there's no mysteries there. So all of these things are what we're looking at and considering while we're still in that due diligence process. So the buyer, again, has a chance to run away if they need to. When they run away, if they choose to not buy this house, what is happening to the due diligence money and the earnest money if they back out while they're still within the due diligence period? What's that buyer walking away from? They're walking away from due diligence for sure, but they should, according to the contract, they should get the earnest money back. It could be that the seller tries to be a jerk and refuses to sign the release. And if that happens, it's not for us as brokers to enforce it. We just have to find out what they want to do and get it in writing. And if they refuse to sign, hand it off to the clerk of court. Then let them handle it. But they're definitely going to lose that due diligence money. Wood destroying insect report. What does it report? It just reports that the inspector looked at anything they could look at without touching it. It specifically says on the report, let me share it with you. It specifically says, hey, I might not can get everywhere on this property. In other words, I promise I can't get behind the kitchen cabinets because I'm not allowed to take them off the wall. They're screwed in. And so it could be that a termite did some damage up behind the cabinets, not even so that you can open the cabinet and look in, but in the baseboard side, the lower ones, there's an opening, there's a cavity between the cabinet itself and the floor. It's like 4-inch little toe kick area. Who knows what's in there? Could be roaches, could be termites. Termite inspector is not going to send a scope or any sort of a visual way or knock it apart, pull it apart. They're not going that deep. They're just going to make an observation from what they can see. And in fact, when they look in the garage, they're not even going to wheel or roll the tool toolkit or tool chest away from the wall to look behind it. They're not touching anything. And you know how people's garages are, stacked and packed, especially when you're selling. And I tell them that as an agent. I say, I'd rather it be in a box in the garage than cluttering up the house. So I've made it worse. But that inspector needs to be able to see the baseboard around the entire perimeter inside that garage. So it's an issue. It's a problem. But all that inspector who's doing that wood destroying insect report is promising is that whatever I can see with my naked eye without touching anything looks good to me. I don't see any sign of pests here. Sorry, I'll pull this up. It's probably a good one. So here's what it looks like. The official North Carolina Wood Destroying Insect Information Report. And all it says is the inspection revealed visible evidence of what? Subterranean termites. And did it look like the owner had done any sort of repairs or control measured or sprayed or put out some sort of termite killer? Or that definitely they have not. They can tell from like the way you treat for termites. One of the ways is that a termite treatment company will drill down like 18 inches with a big old drill bit every couple of feet all the way around the perimeter footers of the house, inside, outside, and especially across the front porch. If you ever see discolored, almost a dime size circle every couple of feet across near the edge of the house, across the concrete, that's probably drill marks from a termite treatment company that then squirted poison in there and then filled it in with a concrete sealer kind of a thing. So there's a clue, and a good pest inspection person, wood destroying person, is going to see that signs of control measures like that. Visible evidence of a previously treated infestation, which now appears to be inactive. If they see some damaged wood, they're going to poke a screwdriver in there, dig around, see if it comes apart, and see if there's any still termites in there. And then the part about powder post beetles, same questions, old house borers, maybe carpenter bees. Or the best answer that we like to see is number 4. Didn't see any evidence from any wood-destroying insects. That's a happy day. One less thing to worry about. They will also note on the report conditions conducive to termites, meaning conditions that encourage them to show up. And so what do termites like to eat? Wood. And they like, if they could go to a place that has both food and water, then that is conducive to termites. So if you've ever put a cardboard box in your crawl space and it's just sitting on the dirt, go get it after class. Get it out of there, because that wood is going to get water in it, just going to absorb moisture. Now you've got a product they like to eat, the paper or the wood, that's also wet. They're getting food and drink all in the same shot, much more conducive to termites. Any sort of wood should not be in the crawl space or boxes or anything like that. Even like wood mulch up against the house. Those are considered conditions conducive to termites. And then if it's a wood-sided house and the wood siding actually touches the soil, where the termite doesn't have to go far, they don't like light. They're very sensitive, and so they make tunnels that they travel through. And so if they don't have to go far with that tunnel to get to the wood or paper and water, it's conditions that are conducive to subterranean termites. So they might not have seen the termites, but they saw that there was wood in the crawl space. So that could be enough. Oh, good. That worked better. It's even easier to see. So that's the standard one that we're looking for. This is what we want as a buyer agent for our buyers, to see this with number 4 checked. And then on the back, it's got some fine print. It says, this is based on observations of the inspector. Note that all buildings have some structural members not accessible or visible. In other words, they're not going to pull cabinets off the wall and look behind them. Not always possible to determine if termites are there without extensive probing, which is more than this inspection is authorized to do. An actual dismantling of parts of the structure And so that sort of extra effort has not been done, nor is it required to be done. This inspection and report is based on what was visible at the time of inspection. And as a buyer agent, you might want to take a better step, and say, hey, listing agent, could you have your seller pull any sort of boxes and toolboxes and stuff away from the walls of the garage if possible, so our termite guy can see the baseboard, the wood trim piece that's around the bottom all the way around. That's where termites tend to show up first. An opinion is not given on areas that were enclosed or not accessible because they couldn't see it. Might be concealed by stuff. Things were not moved for inspection purposes, including insulation, appliances, equipment, fixed ceilings. Do not include where visible access would require drills or ladders. And then detached garages and buildings are not included unless specifically noted. If you want to get an extra report on those, you can, but they're not included. And so me nor the company I work for have had or any interest in the property. Is it any sort of a conflict of interest? Am I part of the buyer or one of the buyers? No. I'm not associated in any way with this transaction. And then signatures down here, the buyer will eventually, probably not until closing. That'll be one of the things the attorney, and if not the attorney, you, the broker, needs to pull out and say, hey, buyer, go ahead and sign this for us, acknowledging that you see the results of this termite or wood destroying insect report. So what does this thing say? Back to the slides. What does it report? It reports on the status today of what the inspector could see with their naked eye without moving anything around. What does it not report? It will not guarantee that there are no termites. It is not a 100% guarantee because it might not be able to see everywhere. And another place could be under the stairs, because sometimes you can't see all the way under the stairs. That closet under the stairs only goes back a couple of feet maybe. And the rest of that space all the way down to the floor is completely closed in by the sheetrock and the walls. Therefore, that's another spot that they can't account for, and they're not going to take a hammer to the wall so they can look behind the wall, right? So it does not report that or guarantee no termites. It does report on this day, from what I could see without moving things around, none were there. Negotiations for the repairs need to be completed by the end of due diligence period, but not the repairs themselves. And forgive me, I think I did it again. Do I owe you a break? I think it's been break time. Sorry, guys. Feel free to interrupt me. I don't mind that a bit, because apparently I'm getting really bad about it. Anytime we get to the 20-minute after mark or beyond, go ahead and raise your hand or tell me or stop me. Yeah, we were kind of in the middle of a thing, but that's okay. I don't mind stopping. I'll see you back here in 10. catch up in the chat. Yeah, the additional earnest money, you got it. By doing it that way, instead of using initial earnest money, we can set the date it's due to maybe the same day as the due diligence deadline, so that if the seller tries to pull that nonsense of refusing to release it, oh, sorry, there is no due diligence or earnest money yet because we didn't have to submit it yet because that was today. So yeah, that's that fun little trick. You bet. Okay. So repairs. We've had it inspected, maybe by several different inspectors. Maybe the basic. Let's look at that for a second. What's that look like in real life? The basic general inspection, structural, mechanical, right? They're going to look at the systems like the HVAC, heating and air system, the water heater, the dishwasher, the appliances. They're also going to look at the attic, make sure that the trusses up in the attic look good, no cracks, and the foundation looks good, no cracks. I mean, that could be anywhere from $500 to $1,000, depending on the age of the house and the size of the house. And then maybe that basic structural mechanical inspector says, I saw some signs of fungal growth. In other words, mold. So a mold inspection is going to be probably $300 or $400 just for them to go out there and do the inspection. But if you want them to take samples of the air and also the substance, the mold itself, that's probably going to be at least $100 per sample. So that could get on up to that $600 plus range by itself real quick. And then, it's on a basement, so maybe radon gas is more possible. That's probably an add-on done by the same inspector that did the basic, maybe like another $150. The wood destroying insect report, probably another $100 or maybe a little less than that. Maybe there is a foundation item, a crack in the foundation, and so we need to get a structural engineer's letter. Structural engineer, basically the PhD of real estate. They go out there, they say, is this safe or could it fall down? And to get a structural engineer's letter, at least $500. And what they'll do is look at it, give you opinions about possible repairs that are needed if needed. They don't do the repair, or they shouldn't. I wouldn't want to hire one who does the repair because that'd be a conflict of interest. Of course they're going to say it needs a repair. What else? Mold. If it's a synthetic stucco house, EIFS is the acronym. I never remember what it stands for. But that's another, I don't even know off the top of my head. I haven't had one done in a while. So I'd say at least $500 to $1,000 for that. A septic inspection. Need to do that one, and that might be $150. And then maybe, of course, the survey to see if everything is cool. That's going to depend on how many acres. At least 500, maybe a couple of thousand if it's like a 10-acre parcel and it's like thick woods that he has to walk through and mark the corners and the edges and put the stakes. So, I mean, that could be 500 plus. So real quick, even after paying that due diligence fee along with the initial offer getting accepted, what are we at? Even the bare minimum, it's 11, that's 1250, that's 1350, that's 1850, that's 2350, that's 2500. We're at $3,000 worth of repairs and survey. Oh, and don't forget probably more than that. $500 for the appraisal. Got to pay that up front. We're at $3,500. And not even including the due diligence fee that it took to get that seller's attention. Do you think the buyer's a little concerned about every step of the way after having that much money that they could maybe walk away from? So how much due diligence money is it? It better be enough that they're worried about walking away from it more so than having had to spend the $35 to get to this point, right? So did the things that these items reveal scare them enough that they're willing to have spent the $35 on all this plus walk away from whatever the due diligence money was? And when it's a brand new buyer, brand new to our area, who's not used to this process, you better explain it sooner than later so they can understand this is a big deal. This isn't just a, hey, let's just see what happens. You're going to be out of pocket, and especially if it's a buyer who's getting FHA money or VA money, or any sort of a buyer that is upfront cash sensitive. Because if it's an FHA buyer, they're probably FHA because they can only put 3.5% down. And now they're also potentially walking away from earnest money if they don't figure all this out before the due diligence deadline. And so they can't just jump back in the market if this one fails. So we've got a lot of reasons as a buyer agent to be very sensitive to the kind of financing they're getting so that we don't lead them down a path that results in failure. We want to have the best chance of success because if this thing falls apart, it could mean that they're not able to try again, at least for another year, because they got to make the money back that they spent trying this one between losing the due diligence plus losing all of these repair costs. It's a lot of responsibility, right, on our shoulders. When are the negotiations for the repairs due? When should they be done? That's what's due by the end of the due diligence period. We just want to have it in writing that the seller is willing to fix whatever they're willing to fix. And what does that look like? Let's take a look at the form. And it's a form called the agreement to amend. So amend, that's an amendment because we are under contract, right? It's not an addendum, it's an amendment. And it looks like this. Well, sorry, led you astray. If we're handling a money thing, if instead of fixing it, the seller just wants to give the buyer money, then we would use the agreement to amend because we could go down here and say expenses. The amount the seller will pay toward the buyer's expenses is changing from this, maybe 0. Maybe they've already agreed to 1,000, but we need to bump it up to 5,000. From this to that. By the way, if we want to negotiate, as we're a buyer agent, if we want to negotiate that the seller is paying some money to the buyer in lieu of repairs, the first thing we need to check is, will the lender allow it to be done? Because the lender isn't okay with the seller just throwing a bunch of money at the buyer. Because they're worried, well, if the seller's throwing $20,000 at the buyer, is that because of repairs or is that because the buyer can't afford this house without getting that kind of amount of help from the seller? And therefore, they're setting them up for failure and they'd be more likely to maybe not make their payment down the road. And so we'd end up foreclosing on it. So any sort of money going to the buyer from anybody, whether it's us as an agent giving them a rebate or the seller giving it to the buyer because of repairs instead of repairs, needs to be run by the lender first, get lender approval. Can't hide that fact from the lender because that could constitute loan fraud. The one I meant to show you is the due diligence form. Oh boy. Oh my goodness. Get down. These boys are crazy. This is the form that we use for the repairs. So if we're asking the seller to fix stuff, it's just a one-pager. It's called a due diligence request and agreement. You don't need to know that. But I'm going to just show you where it's handled. It's the buyer, it's the seller, it's the property, and it's worded this way. Based on the buyer's due diligence, they are requesting and the seller agrees to the following. And then we just fill in the blanks. It's another one of those multiple blank situations. They even make a note in the blue box. If we're going to change the price instead of repairs or the amount the seller's paying toward the buyer's expenses, it's not this form. We need to use the other form. It points them in the right direction because frequently agents, especially old-time agents that were around longer than these forms, will use it wrong. And they'll try to use this form for money too. And they'll say, hey, we want you to fix the dryer vent, we want you to fix the loose doorknob, and we want you to give $3,000 to the buyer's closing costs. Nope, wrong. Tell us about the knobs and the vent on this form. Tell us about the 3,000 on that other form I showed you. So you got to do this stuff right. Reasonable skill and care, know which forms to use. Here's the basic overall advice about this repair process. Don't be an inspector. We're brokers. We're not inspectors. So don't interpret, don't make any sort of representation on this form except referencing the inspection report. So instead of saying you need to fix the roof vent because it should be this and no, that's beyond our scope. Just say item 4 from the attached inspection report. You're just pointing them to some other professional, the inspector's report. Fix that as stated in the report. Items 7, 8, 9, and 10. As shown by the attached report. And then down here it says, does the buyer agree to release the inspection report to the seller? I don't really see a reason why not. But it is up to the buyer to allow it or not. And so I check, yes, they do, because we want that seller to see the pictures and the full scope of what the report says about these items that we're asking them to fix. And so this is what's needed by the end of due diligence deadline. Just this. It doesn't need to be fixed yet. It just needs to have it in writing, signed by the seller, so that you have an actionable, enforceable, funny that they don't actually call it an amendment. They call it a due diligence request and agreement, but it's an amendment. So that's where that is. That's what that looks like. So negotiations need to be completed by end of due diligence. When are repairs completed? You have up until the walkthrough before closing to do those repairs as a seller. And what are the seller's options? How could they answer this request for repairs and maybe credit toward the buyer's closing costs? They can say, yep, sounds good to me, I'll do it. Or they could say, nope, not doing any of it. Don't you know we're in a seller's market? Go find another house. I dare you. Maybe they don't say all that. Or they could say, let's meet somewhere in between. Let's negotiate it. You want 3, 5, 7, and 9? How about just 3 and 5 and 7, not 9? And that's what I did last time. They said it was probably about 12 items, but one of those items was replacing the big picture window. And after me doing some research and getting a quote or two from some window people, I found out that's a $2,000 item. And so we fixed everything but that, and we turned them down on that, and they went with it. It was funny, not funny. I was actually annoyed. It was on my anniversary. We were going to brunch, and that's, of course, in this business, is when the important stuff pops up, is when you're trying to take personal time. And the buyer agent sent me and texted me the notification. Here's what we're asking for, and it's a pretty heightened level of. It's a pretty important moment. I'm like, oh boy, let me see what they're asking for, if this is going to kill the deal or not for my seller. And I called him to get his, because you're trying to feel him out a little bit. Hey, what's important to your client? Try to get some idea. Did they really care about all of this, or are they just padding it, knowing they're going to turn down 3 of them? And just trying to find out, what can my client turn down? And he was good though. I said, well, what's most important to your client? And he's like, well, it's all important to him. And frankly, I know this client. I've worked with them before, and she will walk away over this stuff, whether that's true or not. And clearly it wasn't, because we didn't do all of it. We came back and ended up saying no to the most expensive item, and she still bought it. But he did what he was supposed to do. That's how it can get, guys, right? You could be up against somebody that's a tough player. If anybody plays poker, I don't. But you got to have that poker face, you got to be able to call bluffs and be bluffable. So, or not be bluffable, I guess, give the bluff, right? And call them out sometimes. And all you can then ultimately do is tell your client, here's what they said, and maybe give them your impression of how that came across. She asked me, do you think he really means it, that they won't fix it? And I'm like, I really don't know. I just know that here's your options. If you fix everything, then we're going to move forward. If you fix nothing, then they can walk away. And they're walking away from the $4,000 of due diligence money. Or if you meet somewhere in the middle. So our real question is, How much are all these repairs going to cost you? And do we want to gamble that that buyer is going to be willing to walk away from $4,000 of due diligence money if you won't fix some of this stuff? And so when it got down to the only thing outstanding was the $2,000 window, I've started feeling okay. I don't think the buyer's going to walk away from $4,000 because we won't cover a $2,000 item. I started to kind of feel a little more confident about it by that point, especially in the fact that it's a seller's market. So that's a thing, that's part of it along the way. See this dog nose here? He's a little invasive. He wants to go outside. Okay, what else? Seller can say yes, no, or negotiate. The final walkthrough. This is the point at which we're letting that buyer see the property, but right before closing. I would rather do this final walkthrough not the day of closing. I'd rather do it at least the day before closing. And actually, a step better than that, as soon as I get word from the listing agent that all the repairs have been done, I want to go ahead and go see it myself at least. Hopefully several days or a week before closing. Because here's what a savvy, kind of underhanded seller and listing agent could try to do. Maybe the items were that the windows need to be replaced because of the fogginess. And so the inspector blue taped 8 or 10 windows that needed to be replaced. And you get there the morning of closing for the final walkthrough to show it to your client, making sure the property is pretty much in the same or better condition as when they decided to buy it, besides reasonable wear and tear. And it might be vacant because the seller might have moved out. And maybe when they moved out, they knocked a hole in the wall because the movers were clumsy. You're checking that too. And maybe they pulled up some rugs, and under the rug shows the big cigarette burn in the carpet that you didn't see when you looked at it when they made the offer. Or once they pulled the bed away from the wall, big damage to the wall. Or termite damage that the inspector couldn't see because there was too much stuff in the garage. All that sort of thing, plus verifying that the repairs were done. So you get there and you're walking through and you're like, wait a minute. 8 windows were supposed to be replaced. They told us they were replaced, but I'm still seeing 3 foggy windows. And that blue tape that I know was there because I saw the inspector put it on there is now gone. And you call the listing agent with your tummy feeling bad and you're like, hey, there's still 3 foggy windows. What? Oh no, I thought we fixed every window that was foggy. And you're like, no, we told you exact windows and here they are. It's this one, this one, this one. It was 8 of them. There's only 5 fixed. There's still 3. Oh man, I'm sorry. We tried. And what they're basically saying, you know what a joust is? Like in the medieval times when you're jousting and you're on a horse with a long stick and you're riding toward each other and you're seeing if you can poke them off of their horse or they poke you. You're jousting in that moment. You are saying, hey, listing agent, you didn't do everything you were supposed to do. And they're saying to you, well, I dare you to walk away now because we have a closing in 2 hours and your buyer's stuff is on a moving truck and my seller's already out of the house and your buyer's about to be homeless and their loan process is already finished and got approval and there's a lot of momentum. Is your buyer really willing to walk away at this point with all of this momentum, or are they just going to shut up and sign? And so they may very well be pulling that as a nonsense, dirty trick. So let's get rid of that process too. Let's go ahead back when we got word that the repairs were done. Let's get our lazy butt out there and look at it now while the seller still has a few days to, oops, sorry, I didn't know. Okay, well, go ahead and handle it because you still have a week. Sorry that the window guy missed 3 windows. Good thing we still have 2 weeks to go. You can go ahead and make it right. Don't let them get away with pulling that over on your buyer and putting them in that awkward position, putting you in that awkward position. Because what could really end up happening in the day of closing scenario is your buyer says, I feel like you should have already figured this out. Why didn't you? And you're like, good point. 3 windows, $200 a window. I guess I'm going to take $600 less from my commission today than I was planning to, just so that you basically shut up and sign and we move forward. Also, not to discount the possibility that they might try to turn you in or at least complain to the real estate commission if you if in any way it's something that they feel you should have done but didn't. Let's get that off the table. Let's make sure things are fixed while it's still time to correct them and not give anybody the benefit of the doubt that they fixed it properly or like they're supposed to. So that's what all that looks like. That final walkthrough should be pretty much boring, no drama. Let's make sure that's just making sure the house is not blown away. There's no major things. I'd rather have done my own final walk a couple of days early in time to catch and fix those sorts of things. And so at the very earliest or latest or whatever word I'm looking for, I would never want to do a final walk on the day of closing unless it's a second one, a follow-up one, right? We know this already. Earnest money is in play once we're outside of the due diligence period. Now that's not coming back to the buyer either. What's the seller concerned with? We know what the buyer's concerned with, all that stuff that cost all that money. The seller is just worried that the buyer's loan is going to get approved and that any other terms in the contract they agreed to are going to be met. Maybe they agreed to leave the pool furniture. Maybe they agreed to leave the storage building. So let's, as brokers, make sure those things are still there during the walkthrough. One time I went in and there was an attached table in the foyer mounted to the wall, and it was supposed to stay, but it was gone with like 5 big old holes in the wall where they had taken it out and didn't even bother to cover over the holes and patch the sheetrock. And I said, look at the contract, listing agent. This thing's supposed to be here. And I think if I recall, because this was 20-some years ago, he said, oh, I'm sorry, that's on a moving truck halfway to wherever they're going. And I'm like, oh, I guess they're going to give us some money in place of this thing they shouldn't have taken with them. Things like that have to be handled, right? So the seller needs to, and you as their agent need to make sure things are the way they should. Even my own client, if we're supposed to leave the TV and I know my seller is maybe a little mad about the negotiations and they feel maybe like they shouldn't have had to take as low as they did, or the buyer asked for too much and they agreed for too much, hindsight being different than in the moment. Maybe they try to take a TV they were supposed to leave, and it's my own seller. And I know that buyer agent and the buyer is going to be looking for this TV that was supposed to stay, and it's in the contract. I'm going to say, hey, seller, my own client, remember, see here on the contract, you're supposed to leave that TV. Oh, well, I guess I should get that back off the moving truck. Yeah, I think you should, because I don't want the drama on the day of closing. Let's keep people in line to do what they were promised to do. I don't want to be having to pay for TVs because somebody, forgot about it, right? So that's what we mean. All kinds of things about the contract terms completed. Deed preparation, again, who pays for that? The seller. It's like selling your car. They pay to wash the car to make it nice and pretty and shiny. They're paying to make the deed so it can be signed over to the buyer. So the standard procedure in a standard contract is that a seller pays to prepare the deed. And that process we've gone through before. The attorney who's handling the closing has also done a title search and made sure no liens were on the property, or if there are liens, they've contacted those lien holders, found out what needs to be paid to those lien holders. So for the proceeds of closing, before they give all the money to the seller, they can use some of it to pay off the liens that are attached, including the mortgage itself, the outstanding mortgage that the seller has on their own house. So what else? What's the seller responsible for? We need to find out about leases that might be in place, paying off that loan that the seller still owes, any sort of personal property. I've had one where the buyers made the offer and there was a big bonus room with a big sectional couch. Don't you love the sectional couches? They're great for living, not so great for moving, because this thing was about 8 different pieces. And it's also not great for trying to find a house with a room that fits the thing that were fit in your last house. It's always fun as a buyer agent when they say, we got to keep the sectional because it was $8,000. And I'm like, no room in the world except this house room fits that sectional. Because sometimes it's just not so much the size, but the shape, the wrong L orientation, right? It might be a right hand instead of a left, and there's no wall in the new place. The buyer wanted the sectional, thank goodness. And they also wanted a desk, the big desk in the office. And so their offer was washer, dryer, refrigerator, sectional couch, and desk. And I told the agent, because it was a newer agent, admittedly, they said, I'm brand new. And I said, well, FYI, my seller is probably okay with all this stuff, but you're going to want to check with the lender because they probably don't want all of that mentioned in the contract. The lender doesn't want to see a whole bunch of stuff in the contract. They'll let you get away with washer, dryer, refrigerator because that's part of the house and sort of having a house. But if you add patio furniture, outdoor building, desk, couch, they don't want to see all that mess, because the question there becomes, are you buying a house with furniture in it, or are you buying furniture with a house around it? How much of this is for real estate? Is the price that you've negotiated that WITS needs to appraise for, how much stuff is going to be included in that price? And how do we know the house is really worth $380 if you're also including $30,000 worth of personal belongings? Therefore, if the lender says, as they probably will, get it out of the contract, the parties, the buyer and seller, are going to say, well, yeah, but how are we going to know that they're actually going to leave it if they agreed to leave it? Well, that's where a bill of sale comes in. It can be a whole separate document, like any sort. If you needed a bill of sale, a receipt for selling something for your tax purposes, or for like a donation they give you when you go to Goodwill or whatever, it's that kind of thing. And the closing attorney has one, a standard one that you can use and just fill in the blanks, or they'll make one for you from scratch. But it's a personal property bill of sale to handle things that aren't basically washer, dryer, or refrigerator. So you need to check for that. That might be another thing that needs to be dealt with during this closing procedure. And then the attorney is also going to check to make sure no unpaid bills are still outstanding over the last 120 days. What does that sound like that we've studied already when it comes to liens? What kind of lien is attached to unpaid bills in the last 120 days? You got it. LeVar says, as usual, right as usual, 120 days, any sort of the roof guy, the plumber, the electrician, you didn't pay your bills, they attached a lien, and that lien could show up at any time, all the way up before and right up to when that attorney records the deed. So they're going to check for all that stuff, and they're going to ask the seller at closing. One of the documents they sign is, have you had any work done in the last 120 days that you haven't paid for? So they go to great lengths, and a lot of this stuff gets caught before it ever becomes an issue because of all that stuff. The buyer's documents for a typical closing, of course, the loan. That's the biggest chunk. And when you stare at that attorney and the papers they have before them that they're about to ask your client to sign, it's probably a couple inches thick worth of papers. And most of that stack are the loan documents. It's definitely the promissory note. It's definitely the deed of trust, but it's also a bunch of other stuff like a tax form so that they can tell the IRS that that you now own more house, or for your seller that they've sold a house. A form about aliases that'll say, tell me here are all the names we've run across when we ran your title search and when we did the buyer credit check and stuff, and any sort of names, especially if you've been married several times and changed your name because of that, all that stuff you have to sign off saying, yep, I've been that person and that person and that person and that. Those are all me, and a whole bunch of other stuff. So loan docs, the title insurance policy, buyer needs to sign that because they're going to pay one time at closing for their owner's coverage, title policy, and the lender's coverage portion too. The wood destroying insect report, we saw that. The survey, they need to sign the survey, hopefully that was done, saying that they received it. And property insurance, they have to deal with that. And what will happen there is they will have shopped for it, picked it. Maybe it's their auto insurance, and they also get a policy for home too. And maybe by having both policies, it's cheaper, usually the way that people will go. And that insurance provider agent will send what's called a binder over to the closing attorney. And they can, with that, see what the policy is, see what the premium is, the first year's insurance premium, because that has to be paid by the buyer at closing, and then setting up the escrow for insurance later. So that needs to happen during that due diligence period, and those papers are going to be as a part of that stuff that gets signed too. We just talked about this. The title insurance policy paid one time, not monthly, but once up at closing. Great deal because it covers the buyer and the lender. And once, by the way, the loan gets paid off completely, that lender policy is no longer needed. Just the borrower policy stays in place then. Let's see where we are. We've got more stuff about procedures. And then definitely the next Wednesday, we'll finish this chapter and we'll get into the math. So, by the way, don't forget the math from last night in the page I gave you. Let's see, where is that going to show up? Looks like this. So either go back in the chat and pull it. I'll attach it again if any of you didn't get it earlier. Here we go. There it is again. It's also in Notion. Oh, and I'll email it too. That's right. I need to email. I'll do that before I get up from this chair tonight. So work on that. Read ahead. Read your closing chapter 21. Look at that math. Go ahead and look at that math and we're going to talk about tax proration, how we have to handle taxes. Because if you think about it, if we're closing halfway through the year, the seller should pay for the amount they lived there, and the buyer needs to be responsible for the amount they're going to be there through the rest of the year. So we'll see how that math works. And besides that, have a great week. Go ahead and do your midterm and bring me any questions from that we need to talk about as well. Appreciate you guys. Have a great weekend. See you later.